Hello everyone and welcome to the virtual launch of Curate Investments. A couple of weeks ago we hosted the in-person launches and today we're delighted to be able to engage with so many more of our clients at this virtual broadcast. During the broadcast you'll be introduced to the art of investing and how Curate Investments aims to make things simple for financial advisors and their clients. You'll also get to know how Curate goes beyond the numbers and experience the people behind the portfolios. You'll hear from the 8 managers that we have handpicked to create an offering designed for you. The presenters will introduce themselves and share their insights on the strategies they employ, the opportunities and trends they see, and how they navigate challenges to consistently deliver results. One of the advantages of being virtual is the ability to engage on the platform throughout the sessions. Please use the opportunity to ask any questions that you may have in the Q&A section, as our team is on hand to answer all your questions. After November, all the videos will be available on our website, so please go to www.curateinvestments.com. Thank you very much for joining us today, and thank you for trusting us with your clients' hard-earned money.
What a privilege it is to welcome you to the official launch of Curate Investments. My name is Ilana Afrika Bredenkamp. It is a huge honor for me to be here today. You know, something that I've noticed today, if you look at our manifesto, and please later on go and have a look, you'll see it on my left-hand side. The one thing about today is that Curate Investments handpicks people from all around the globe. And when I realized that I was handpicked as an MC here today, I'm just going to roll with it, okay? I feel incredibly lucky and I feel really blessed to be here. So thank you so much for having me here as well. You know, today is more than an unveiling of a brand. Leading up to today and seeing some of the meetings that have transpired, I got to learn that today is all about a concept. It's about a new way of seeing potential in every opportunity. With the ever-increasing number of investment options and the complexity in the world, we always talk about how busy it is. We talk about technology and all these things that are trying to take over. You know what? The need for simplicity and a trusted partner in fund selection, there's never been a better time, and it's never been more relevant than now. That's why we are extremely excited about the lineup of speakers here today. Speakers from South Africa, the US, where are you? Oh, they're so excited. I saw their hands. Also from the UK, let's give them a warm South African welcome. Thank you. Thanks for being here. It's also wonderful to have our internationals join us for the very first time, so we don't take it lightly. A huge and a big South African welcome to each and every one of you. Also, you'll find out about their insights and their strategies that they employ, the opportunity to see how they unpack trends. Also in our discussions, and I love and enjoy a discussion on stage. Later on, we will see how they deliver results. Now, we are going to take you on a journey of curation. Earlier, I mentioned some form of art and mastery. And I mean that, the art of investment. I see some of you are on your phones. We encourage that today. So keep your phone on silent, but today we want you to engage on social media as well. If you haven't done so already, try and master and familiarize yourself with the art of a selfie. We want you to take to social media today because the success of today's event is up to you. So on LinkedIn, we would like you to follow us. So it is Curate Investments on LinkedIn. Also, if you use any other social media platform, you're also welcome to tag us at Curate Investments in your post. So you can use it as a hashtag as well. So engage in pictures in real time. Oh, speaking of which, this QR code behind me also gives you insight on some of the images that's being taken in real time. So please download it and see how you can engage with our pictures as well as with Mentimeter here in front of you. Okay, well, with that bit of formality out of the way, I think we can get started. Are you ready? Gentleman's using his eyes. I'm getting a clap. I think we're all ready. All right, I'm thrilled to introduce our very first speaker for today, our CEO of Momentum Group. Now, Jeanette, it's always wonderful to see you. It is also really special because I've journeyed with you to understand your exemplary leadership and I can't wait to hear from you today. Curate is also the materialization of a dream. For quite some time, Jeanette has really wanted to implement this. So I'm really excited to be part of today. So please join me in welcoming Jeanette to stage. Let's give her a warm round of applause. You have to keep clapping. Thanks so much. How are you?
Joining you.
Good, thanks.
Ilana, never a good idea to upstage the CEO. No one told me that's how I needed to be dressed for today. You look amazing. Hello, everybody. And a real huge thank you from me. What a vibe. It was so fantastic to arrive here and just see all of you here. And I think it's been too long since we've had an opportunity like this to not only bring you something really amazing, something that we're very, very excited about, but also share it with you and something that I believe is again a new era in our fund management industry. So real privilege for me to be here today. So, is that rain? Whoa, okay. That wasn't planned. As Ilana have said, the birth of Curate has been something very, very close to my heart for actually since the day when I returned to the group in 2018 and I was CEO of Momentum Investments. And we always knew that there was a massive opportunity for us to do something really special in what I would call a quite crowded industry. So you might stand here today or sit here today and wonder, is there place for another asset manager? Is there place for another set of funds? But let me share with you my dream and how I think about it. So why did we start Curate? I want to start with a personal philosophy of mine, and that is that in business, you often have to look beyond the numbers. And if you apply that to investments, we wanted to perfect the art of investing. And I hope that as the day unfolds, you will see that and you will feel how we've made that difference. We're bringing that new way of doing business into this market. But we also know that you as our advisor partners want to pick the best funds for your clients. And in a very crowded world, that's often very, very hard to do. So we wanted to create something that is not only a comprehensive range of funds, but that will also make it easier for you to pick these funds for your individual clients. Make your lives a little bit easier. And in a way, we wanted to do the hard work for you to try and help you pick the best possible portfolios for your clients. We also know that we have a large and top performing retail distribution network. Now, those of you that have seen our results presentation recently will know that we now, as a group, proudly occupy the top spot in the advisor space, in the independent advisor space in South Africa. Now, you've also heard that we're wanting to invest aggressively in advice, but I'll talk about that a little bit more. And this is really what we saw as the opportunity for us. So in the past, we had a platform, we had a fantastic relationship with IFAs, with our own advice network, but we never really had a fund range that was appealing to financial advisors to use in their portfolios. And that really left us with a gap that we wanted to fill. Now, there are 3 ways of doing this, and it took us a long time to actually decide what was exactly the best way for us to do it. You could buy those skills, or you can build it, or you can partner towards it. Now, we know that it takes a very long time to build a fund management capability. I mean, that's not something that you do overnight. And it takes even longer to build a credible track record. So that made it quite easy for us to discard the first option. But we also know that there's a perception that life insurance companies are not great fund managers. And sometimes those perceptions are there because of years and years of history, and it's very, very hard to change that. So we decided not to compromise, but go for the third route. Find the best possible partners we can possibly find everywhere in the world and bring those to you. And we know that that is something that we've been great at for many years. We've shown it in our partnership with IMG a year or so ago when we bought a big stake in that business. And in terms of our multi-manager portfolios, top performing funds for many years, we have a great expertise to pick and choose the best fund managers from around the world. So we said, let's go and find managers who also want to partner with us, who also see in us a partner that could benefit them, because it actually goes two ways. So the result is that we have put together a top-of-class partnership to offer you and your clients the best in the easiest way. And that is Curate. A combination of expertise and simplicity. And to be honest with you, personally, I couldn't be prouder that that name and that brand was born from the Momentum Group. Something that we've really worked hard at for a long time, and it really aligns perfectly with the Momentum's group purpose and with our strategy. And if you'll allow me, I'll take a minute to just explain that to you. So let me start with our purpose. I started by saying that in business, I think that you need to look beyond numbers. People make the mistake of thinking that we're in the business of money. It'd be logical to think that. But we have realized over the last year in developing our group's purpose that we're in the business of people and high emotion. Because behind every transaction, every decision, and every interaction, there's a human being with fears, hopes, dreams, and aspirations. And that's why our purpose is to build and protect our clients' financial dreams. We also recently announced our impact strategy to the market, which is the next 3-year strategy for us as a group. And 2 of our 6, and we only picked 6 strategic objectives that we want to achieve over the next 3 years. And 2 of them actually directly relate to why we're here today. The first one is that we want to address or invest aggressively in financial advice. Because as a group, we fundamentally believe that there's a place and a great future for you, the financial advisor, the human being on the other side of every single client and every single relationship that we have with clients. Secondly, we have chosen that we want to design impactful and simplify client experiences. And I hope that today you will see that Curate not only fits our purpose perfectly, but also aligns very, very well with these strategic objectives that we want to achieve. So, I told you that this was a dream of mine for a while. I had a team together, we started working on some ideas, and then we needed to choose a leader. And I do want to maybe spend a minute on sharing with you why Ray is the person that we chose as the CEO of this group. Because I think, again, we do business with people. And we do business with people that has the ability to put great teams together. And that's why I wanted to chat to you about Ray. So even though we're a large and established group, we are still starting a new business within this group. And for that, you need people who are a little bit more entrepreneurial, a little bit less corporate, and have that entrepreneurial flair to be able to start a business. You also need people that you can really fully trust, because it's a significant strategic step for us as a group. I don't think you often see big groups like ours starting new businesses. You're sometimes gratifying them, but not necessarily starting them. And lastly, because we are a business with heart, you need a person who shares that passion for clients and that passion for advisors. What some of you might not know is that Ray and I have worked together for, I think, more than 14 years now. We've known each other. And for a long period of that, Ray was a young protege of mine that I found when we worked together at Allan Gray. And I saw the potential of this guy. He actually started in the call center in Allan Gray. And I gave him an opportunity. And subsequent to that, I gave him many other opportunities. And every time I did, Ray excelled, never disappointed, came to the party every single time. He loves people, he's very smart, and he's also just a really great guy that you will all get to know quite well, I hope, over the next few years. So when I joined Momentum, I went and I fetched Ray, and he worked with us at NDS. We did lose him for a short while, but we promptly fetched him back. And specifically, I brought Ray back to come and start Curate for us. And it's been a year or two of really hard work behind the scenes to get everything ready, but he is with us now. He's been in the investment industry since 2010. He's worked at 3 large asset managers in his career. And I really just think that he understands distribution, understands fund management, and he's a great leader. So why do I think Curate will be successful in what is really a very crowded world? Well, firstly, it has the support of the Momentum Group. And I don't think, and there's many of our asset manager partners here who will know how tough it is to start a new business in this industry without financial backing and the backing of a big group. So firstly, he has the backing of the group. He also has my personal support and my personal interest to make sure that this business is successful. He has a fantastic, dedicated team, a really great team that we've put together. And then I think, more than anything, we have partnered with some of the best managers, and that in the end is what's going to make us successful. So then, very importantly, we believe in the value of financial advice. And I think if you see a company setting out this as only one of 6 of their strategic objectives in their strategy, that they want to invest and support advice, face-to-face advice aggressively, then you know that we really, really mean that. So Curates, the partnership that we have with you, our financial advisors, are equally important. And I think for me, that's part of the art of what it is that we offer here. You as our financial advisors, ourselves as kind of, the facilitator of this relationship, and then of our partnership with the financial, with the fund managers that we all bring together. And that really for me is why I think Curate is here to reduce confusion, simplify, provide solutions, and a great range of unit trust funds managed by the best people from around the world. And you will really hear from all of them today. So Curate has brought, will continue to bring the best global partners to South Africa and make sure that we keep on selecting excellent local fund managers who can be part of this range. And that really is what today is about. For you to have the opportunity to meet the exceptional managers that we are going to be partnering with. And it is also an opportunity for you to judge for yourself whether you think that we've made some great decisions for you. So I hope that you experience the dedication and the energy of everyone involved. And we are really excited about the impact that we promise to make. And Curate is an instrumental part of that promise that we've made you. So lastly, the art of investing is what Curate's slogan is. But what does that mean to me personally? For me, art is all about talent, about skills, and about expertise. But it's also about passion and heart and the simplicity of creation. So, like a good curator of art, we commit all our skill and our passion to handpick only the best people to look after your client's money. Our unique range of unit trust takes the complication out of choosing between different funds because we believe that we've identified exceptional teams of people with the right skills to manage its fund. Each person is not only an expert, but they're also the cream of the crop. What Curate offers and what we do comes from the quality of the people that we work with. And that is the art of investing. So I will stop there. I hope that you're as excited as I am. I hope that you experience all of that here today. And I will now hand back to Ray to tell you about South Africa's newest asset manager, Curate. Thank you.
To curate any exhibition requires comprehensive research, knowing your individual client's tastes, and understanding what shapes and drives their behavior.
Now that makes a pretty picture.
It's interesting. It's really bold.
I agree. The attention to detail is quite something.
You can see how much work went into it.
Somebody's going to be very happy to have this.
Curate is an independent global investment manager with a unique range of funds. Each one is managed by a team of highly skilled people that we have handpicked from top managers around the world to look after our investors' money. We curate each fund to meet a specific investor's need, and we have conducted thorough research to find the people that we believe are most suited to deliver on that. Ultimately, we believe that the art of investing lies in simplifying things. In a market where there are now thousands of different funds to choose from, we give investors a comprehensive range of options. This provides them with access to different strategies, all in one place. It also gives them the comfort that each fund is being managed by a team that has been handpicked through a detailed research process.
We set the bar high so that we know we can trust those we select to look after our clients' money. Our research team has decades of experience, deep relationships across the industry, and a global view that means whether we are looking for managers in the US, Europe, South Africa, or anywhere else across the world, we hold them to the same high standards.
Our investors have reassurance that they don't need to search through thousands of different funds to find the reliable and trustworthy managers, because we've done that on their behalf. It's all part of giving investors access to the very best investment ideas. So why consider Curate as your investment manager of choice? Firstly, because we believe in having an investor-centered range of funds. Each of our funds is designed to meet a particular client need, such as saving for your future goals, growing wealth for your children and grandchildren, or ensuring that you have a balanced global portfolio.
We also believe in simplicity. We will always be transparent and keep things relevant so that you face as few surprises along your investment journey as possible.
We have a global reach. We research managers across the world to find the people we believe are most suited to delivering on what our investors require, wherever they may be.
And we believe that the best people have the highest standards. The people we handpick to be our long-term partners must offer something unique and show integrity, loyalty, and a record of delivering returns for our investors. Speak to us today or go to curateinvestments.com to find out more about Curate or the art of investing.
Thank you, Jeanette. I think I teared up back there and forgot what I was supposed to say today, so please bear with me. The last 15 years has been phenomenal, and working aside a woman like Jeanette has been absolutely amazing, and I look forward to the next 15 years with her at the head of the Momentum Group. I think you can see just after 1 year of her running the group, the changes and also, I suppose, the market, the way the market has responded to our business has been absolutely fantastic. And you'll see today with Curate will be an extension of that. Good afternoon, everyone, and welcome to the launch of South Africa's latest and newest asset manager, Curate Investments. Thanks, Ilana. What does it mean to curate? To curate means two things. One is to take care of something. The next is to put together only the best and put them on display. And if you think about what we do, it was quite simple why we chose that name. It's very similar to what we do. Not only do we select some of the best managers both locally and globally, we then take care of your clients' money and make sure that they're taken care of throughout the investment process. You must indulge us. For people like me, Natalie and Ali, if you see something called Curate and things like art and the art of investing, you will for the next few years also have to settle with an investment manager that's going to bring something slightly different. There's going to be dancing, there's going to be art, but I think it's quite fresh and unique in an industry that is full of hard lines, charts, and graphs. We will continue to give you hard lines, charts, and graphs, but I hope you enjoy the entertainment as well. We certainly do. It is a bit out there, but I love it. I hope you do too. So in all of our narrative, you hear us talk about how we handpick the best people. And the key word there is people. You're going to hear today from all the managers that manage some of the portfolios, and I hope you spend the time with us this evening to engage with myself, the team, and those investment managers, and to truly understand what we mean when we talk about the best people. It's not just about the numbers. How many times do you go off and meet someone, and brilliant as they are, as an individual, it's quite hard to engage with that individual. When we went out to find managers, we specifically looked for people that are fantastic to engage with, people that are great investment managers, top performers, but ultimately really good people. What we also do at Curate is we also understand that one investment manager can't do everything and be the best at everything. So we've given mandates to multiple managers because we think that you'd rather take the approach of giving different investment managers who are experts in their field the different funds to manage on our behalf. When we started the business, we also thought about what would be the guiding principles that we as a business would live by. And we said to ourselves, we want to be a global investment manager that values simplicity, excellence, and relevance, and also exclusivity, which I'll touch on now. I'll touch on all of those now. What does it mean to be a global manager? Not only are these fund managers based globally, our funds are also available globally. Our global range of funds are accessible in the UK, the Middle East, Southeast Asia, and Latin America. Today, we're thrilled to introduce you to those managers who are both locally and globally based, from Boston in the United States, New York in the United States, Oxford in the UK, Rotterdam in the Netherlands, and then obviously Cape Town and Johannesburg here in South Africa. Why do we do this? As Jeanette mentioned, the universe is full of choice. If you look in South Africa now, there's close to 2,000 unit trust funds, creating what people call the paradox of choice, where people are becoming overwhelmed by this choice. Our job here at Curate is to go out and go look for those investment managers so that you and your clients don't have to. If you look globally, it's even more important to provide that simplicity. Close to 150,000 funds. And then if you add the regulatory requirements, we can't even access some of those funds without certain licensing, and we make it very difficult for those fund managers to come to South Africa. So we as Curate have taken it upon ourselves to go and research those managers across the globe and bring them here and showcase them in South Africa and expose them to an entirely new market. You'll see some of them at the back and you'll hear them. They came as a team. This is a big commitment from some of the global managers and the local managers, because essentially what you're doing is you're partnering up with Curate on the mandates that we believe you're best at, and you're allowing us to take that out to market. Who are these people and what do we mean by excellence? When we talk about excellence, we're looking for top performers. We're looking for people with the highest integrity. And we're looking for people who are committed to delivering value for our clients. Our manager research team, as mentioned in the video, is based here in the UK, in South Africa and in the UK. They've got extensive knowledge and decades of experience. They go out there and they ensure that these standards are met by doing quantitative analysis, manager visits, and extensive due diligence on these managers. And we commit to continuously keep these managers on their toes so that they continuously do what's right for you and our clients. Then exclusivity. This one is very important both for us and for the underlying investment manager. For this relationship to work, whenever we provide them, we select their best manager and we say to them, we believe that you are the best at this specific mandate. We then ask them to give up their mandate and allow us to market and distribute it under Curate. That is an exclusive relationship. That is to ensure that all of our clients can find only the best under one umbrella, which is that Curate Investments umbrella. That is an agreement that we have with those managers, and it's not an agreement that people get into lightly. I hope it shows you the commitment that we and our managers have to each other and the types of relationships that we're trying to build over the long term with these managers. Now, the relevance piece is, I've been in the investment industry for a long time. And often what we've done is we've created things and sold them and expected clients to buy it because we thought it was fantastic. It was a fantastic idea. When we talk about relevance, we talk about listening to the client feedback. We talk about hearing what our clients' needs are. And that's how we came up with our initial launch range of funds. When we created this launch range of funds, we did our own research we asked an external company to do research, we asked our distribution teams their feedback, and we also asked financial advisors for their feedback. 3 key things came out in terms of what clients are looking for currently, which has influenced what that launch range looks like. What we're going to show you today, the funds and the managers, is the launch range, but we do have ambitions to grow that fund range based on your requirements, your needs, and what your clients are looking for. But the launch range itself is focused on 3 key themes. Clients told us there's a need for income, there's a need for capital growth, and there's a need for global diversification. So what does that range look like today? From a fixed income perspective, Curate has 3 funds. The Curate Enhanced Yield Fund, the Curate Flexible Income Fund, and the Curate Income Plus Fund. All 3 funds managed by the Momentum Fixed Income team. From a capital growth perspective, we took a local view here, and we created a Curate Equity Fund managed by Laurium Capital, Curate Flexible Property Fund managed by Sesfikile, and Curate Balance Fund managed by Visio. 3 managers that have got fantastic track records in the country and have proven themselves over and above. And we've got the opportunity to partner with them and bring them to the South African market. From a global diversification perspective, we partnered with 4 managers. The 3 on the right are active managers, and the first one on the left is a systematic, data-driven manager. The active managers are Evenlode, who manage the Curate Global Quality Fund, Lyrical manages the Curate Global Value Fund, and Jennison Associates manages the Curate Global Growth Fund. Again, fantastic managers with long-term track records and have shown that they have delivered for their clients in their own jurisdictions. And we are bringing them to South Africa for the very first time. And once again, like I said, them being here and bringing their entire teams to South Africa, even in the middle of a United States election, shows you the commitment to the South African market and to Curate as well. Before we get to each of these managers presenting to you and showcasing their own capabilities, I want to just touch on Robeco. Unfortunately, Robeco couldn't come to this event, but they will be joining us. Tabo from the Robeco team is here, but the main portfolio manager couldn't make it for this event. They have, however, shared a video that I'll share with you now. Robeco manages, like I said, Robeco is a data-driven systematic manager, and they manage the Curate Sustainable Equity Fund and also the Curate Emerging Market Fund. And here's a video from Robeco.
It all starts with a number. A clear, seemingly unambiguous number. As investment engineers, we always base our decisions on research, on analysis and interpretation, indeed, on numbers. With sustainability, it's no different. Where others might use words that are trendy, superficial, or cliched, we quantify sustainability by using numbers, data, models, facts. With our SDG framework, we systematically assess individual companies on UN SDG contributions. Our SDG scores guide the way we construct investment portfolios to ensure the progress they pursue is sustainable in the economy, society, and the environment. We quantify company and sector influence on specific themes like climate and biodiversity. And we continuously search for new data sources that will help us determine which companies will become tomorrow's sustainability leaders. What's more, we don't keep data to ourselves. We share SDG scores in our Open Access Initiative. This is where we invite academics and clients to work with our assessments and to challenge them, because quantifying sustainability is an ongoing cooperative process. We are passionately curious, and as much as we love numbers, it is the world beyond them that fascinates us even more. We continuously analyze our data and interpretations to assess whether they truly reflect reality. And if we doubt the data quality, we'll override the numbers or even discard them and start all over. Call it being thorough. Call it science. Call it simple common sense, but this approach to sustainability serves our clients by helping to see risks and generate performance. And just as importantly, it is an approach that aims to protect the planet for future generations. That's your kids and ours. Robeco, the investment engineers.
And that is our fund range. As I said, it's the initial launch fund range, and as we get your feedback, we do have ambitions to grow it. A message from me and the team: we fully understand that we're in the business of trust. Your clients and our clients come to us and give us their hard-earned money, expecting us to protect it and grow it. It's a responsibility that you don't take lightly, and we don't take lightly either. My team, myself, we are all accessible, and we want to do things differently. We want to build relationships with you, and we want to help you and your businesses. From me, from a personal perspective, launching in Joburg means a lot to me. I met Digby Brown in the foyer, and he hugged me and he said, "Ray, I came for you." I started 15 years ago in this industry, and the majority of that time in this industry was in this province, was in Johannesburg. I'll notice a lot of you here have been past and present clients, but I must say a lot of you have become really good friends. So from me, I would like to thank you for being here. It means a lot for us, a small new business, to gather so many people in a room like this, for you to be here for the launch of our business, and we look forward to partnering with you from now and beyond. So thank you very much.
Thank you, Ray. As Jeanette was standing here, the weather turned. They always say the wind brings a message. Jeanette, thank you so much. Ray, you said it's all about the people. Thank you so much for your insightful message of trust and possibility, and for even acknowledging some of our good friends that have joined us. Let's give Ray another round of applause. Thanks so much. A powerful message which reminds us that we are definitely here and that we've partnered with a leader in sustainable, systematic investments. But it's all about people today. You heard it. Speaking of which, in person today, you heard it from Ray, are all of Curate's active global equity managers. And we really look forward to hearing from you today as we bring you this lineup and as we paint this town red, or burgundy for that matter. Our first global manager that is joining us is Lyrical Asset Management. We're quite excited. Lyrical manages the Curate Global Value Equity Fund, and it's founded by two long-term friends. Lyrical is a specialist boutique firm. They're based in New York City. Their main focus is finding good companies in the cheapest part of the market, basically, providing investments and investors a good, unique combination of value and growth. Now, I would like to call onto stage our next speaker, our portfolio manager at Lyrical. Please put your hands together for John Mullins. You have to keep clapping. Thanks, John.
At Lyrical, to our core, we're value investors. And what that means is that we only buy stocks from the cheapest part of the market. Now, most companies within the cheap part of the market are not good businesses. But we believe that if we work diligently, we can find good companies hiding out in this cheap part of the market. We call it finding the gems amid the junk. Now, why look for companies in this cheap part of the market? Well, the answer is quite simple. These stocks have delivered the most enduring source of alpha in markets over time. And that's what you see here. This light blue line going back to the 70s shows you our hunting ground, the cheapest quintile, the cheapest 20% of businesses in the world. over time, they've outperformed the MSCI World and the MSCI World Value by more than 5 percentage points per year. And now this is in spite of the fundamentals. As I said, on average, value companies are not good companies. Over this period of time, going back to the 70s, these cheapest 20% of stocks have undergrown the market on an earnings basis by about 3% per year. So why does it work? Well, value works in spite of the fundamentals. Nobody wants to own a bad business, and so therefore it becomes too cheap, and then it re-rates. Now, the Lyrical approach is different than that. We believe that hiding out in that light blue line are some good businesses that can grow their earnings actually at a market rate or faster. And if we can find them, we can deliver fantastic returns by combining value factor returns, just buying the cheap stocks, with the power of compound earnings. Now, how do we locate these businesses? It's through our investment discipline: value, quality, and analyzability. Every company that we own must have these 3 characteristics. Well, value we've discussed. It's the fuel for our returns. Buy stocks in the cheapest part of the market, and you should get the value factor. But we want to do better than that. So first of all, we look for quality companies. To be fair, we're never going to own the best businesses in the world. I'll leave that to some of my peers who will speak next. But we can own good enough companies that have double-digit plus returns on capital. On average, our portfolio is close to the 20% mark. Having those types of returns means that you have a competitive advantage. It means you have a moat, and that makes your business a lot more resilient, and it means you can reinvest at those rates of returns and grow above the market, which we've done, as I'll show you in a moment. Now, the last thing we require, we call it analyzability. And for us, it means keep it simple. There are no style points in investing. You shouldn't care if we go after the complex, difficult situations or the easy-to-predict companies. And so we go after businesses that are predictable, where we can reliably get the earnings right. So this approach, looking for value and looking for quality, it produces a truly uncommon combination of value and growth. And this slide here, it's the most important one to showcase what Lyrical does. These are our portfolio fundamentals. So again, value, it means different things to different people, but to us, it means ridiculously cheap. You can look at our portfolio. We trade for about 10.5 times earnings today. So indeed, we are in that cheap part of the market, but that is not sufficient. Again, we want to do better than that. And we've done that, you can see on the right side, by putting together a portfolio that has delivered compound earnings growth above the MSCI World and above the world value. You can see there, value companies undergrow, but not our companies. Now, good, cheap, and simple. The market is not supposed to give you these 3 things together. And so I often find it's helpful to walk through a couple of examples, which we'll do now. So here we have Ameriprise, and we've owned this stock actually since 2012. And I'm showing you 3 views of Ameriprise. At the top, we have the stock price going back to 2011. In the middle, we have the earnings per share. And at the bottom, we have the PE multiple, or the valuation. So if you take the top chart divided by the middle, you've got the valuation at the bottom. So this company has grown earnings at a 15% rate and trades for 12 times earnings. What is this growthy company? Well, it's a business that you might not know of, but you'd be familiar with what it is. It's a financial advisor. So they have 10,000 financial advisors in the U.S. managing the wealth of 2 million people. So how does it stack up on the Lyrical criteria? Value, quality, analyzability. Well, from a value perspective, 15% earnings growth at 12 times PE, that looks pretty good. And it looks better when we compare it to the MSCI World. That's triple the earnings growth at a near 40% discount. What about quality? Well, as you would know, once you win a client as a financial advisor, those clients tend to stick with you for life. It's a very sticky business, and there's limited capital required for this business, which leads to returns on capital actually north of 40%. Analyzability. Can we predict it? Well, take a look at that earnings line. This is a business that, even though it grows with markets, has had very limited cyclicality, growing earnings even in 2022 when the MSCI World was down by 13%. Now let's look at another one. Speaking of resilient businesses, this is Cigna. Again, a very simple business. It's a healthcare insurer in the US. What they do is they combine the healthcare spending of 20 million individuals, and by doing so, they can negotiate lower healthcare costs on their behalf. How does it look on value? Well, 14% earnings growth. Again, nearly triple the MSCI Worlds. And at the bottom, as you can see, the multiple only 12 times earnings. Again, a near 40% discount to the market. Now, we put together a portfolio of good, cheap, simple businesses, but why should you care? Especially, why should you care when the only thing that seems to work these days are big tech and AI? Well, if you're asking yourself that question, the answer is that that's usually a good time to be buying value stocks. And we see that very clearly here. What this shows you is the market's earnings, PE multiple, so the valuation of the median stock in the world, at about 17 times today, and the valuation of the median cheapest stock at about 8.4 times. And the bottom shows you the spread between the two. It's an incredibly extreme time in the value space today where the market is 100% more expensive, 105% more expensive than the cheapest part of the market. Now, if you go back to the global financial crisis, that spread peaked out at 80%. That was a fantastic time to buy value stocks. Actually, if you want to find a similar spread to this, you have to go back further than we're showing on this chart, which is go to the end of 99 when there's a similar valuation spread. And we all know what happened after that. In 2000, the NASDAQ was down nearly 40%. Cheap stocks went up about 30%, and the MSCI World was down. So why is Lyrical the right firm to get your value exposure? Well, we do this one thing and one thing only. We've been doing it since 2008. We're a boutique based in New York City. And our investment team, our senior investment team, we've all had this same evolution to our philosophy. We all came from the same family of deep value funds, but we all had that personal epiphany where we realized that there were some pretty good companies hiding out in that cheap part of the market. And if we could only hold them for the long term, we could make a lot more money and make our investors more happy. Now at Lyrical, we're different. We're different than the benchmark. We're different than our peers. We have a 99% active share. And what that means is that if you look at us relative to the MSCI World, even though we're buying stocks from the MSCI World, we only have a 1% overlap with that benchmark. And relative to any other global peer, we have very low overlap. It is a unique combination, an uncommon combination of value and growth, and we believe it can provide outstanding returns over the long haul. Thank you.
Thank you so much, John. Can I have my clicker back? I'll meet you halfway. No worry. This is what I call an investment. Thank you. Okay, ladies and gentlemen, I see that you've given a warm round of applause. I think we can give John another one. Thank you so much. Well, next up, we've got Thomas Davis joining us from Jennison Associates, joining us from Boston in the USA. Thomas is one of the portfolio managers on the Curate Global Growth Equity Fund. Jennison is focused on consistently identifying innovation and disruptive ideas and also to drive growth. It is certainly a historic moment. Ray alluded to the fact that there's a lot happening in the US today. So once again, it is a huge honor for you to join us. Both John and Thomas, thank you so much. Let's welcome on stage, Thomas.
It's a real pleasure for me to be here. I'm not sure what kind of a country I'm going to have when I get home, but it's great to be here in South Africa today and be with you. It's also a pleasure to represent Jennison Associates and our global growth-oriented fund. A little bit of a background here. Oops, too far right off the bat. quote from my partner, Mark Barabow, if you have engineered your process to always look for major disruption, you aren't going to miss it. This is a strategy that he and I founded in October of 2004. So we've just passed our 20-year mark with this strategy, continuous management. And if you think about everything that's happened over the last 20 years, we've seen the evolution of the original internet morph into the mobile internet, broadband wireless. We've seen the introduction of smartphones. We've seen the introduction of e-commerce. We have seen the rise of social networks and social media. We have seen the transition towards the cloud and cloud computing. And now we're watching the evolution of AI. We've captured in the portfolio representation in all of those areas, and it has led to a very strong track record of performance. We moved the team to Jennison in 2011, and in the intervening years since our start of the track record in 2011, we have produced just shy of 15% annualized with this strategy, an excess return over the ACWI benchmark of about 600 basis points, just shy of 600 basis points. So it's a strategy that we have created with a process that is specifically focused on identifying the best growth opportunities that I often call the opportunities of today and tomorrow, not yesterday's, not last year's, not last decade's companies. Here we go. Okay, so couple comments on why we invest in, why we believe in growth. First of all, this is an interesting slide. It's an interesting contrast to the value slide. I think it's just a different way of looking at the data, different time periods. But what we've done here is taken the ACWI benchmark and we've quintiled the benchmark over rolling 5-year periods by earnings growth. If you then look at the performance by quintile, you see that the strongest quintiles of growth produce over rolling 5-year periods the strongest return streams. So it's our objective and the work of our analysts to try to find and identify those companies that have the best opportunity, the best shot at ending up in those top quintiles going forward over the next 3 to 5 years. Why do we do this in an active sense? Because actually, there's just not that many of these opportunities out there. If you look at the ACWI again and you look for strong sales growth and strong earnings growth, and you just take, for instance, a 7% or greater top line in sales and a 10% or greater earnings per share number over a 3 to 5 year period, you only have about 27% of the ACWI. So it's not that big of a universe. So it's really incumbent that you have a very talented team of analysts, very experienced, very tenured team of analysts focusing on growth every day, trying to find those needles in the haystack. And that's what we have at Jennison, where many of our analysts have been with us for 15, 20, and 25 years covering their sectors. What is it we're trying to exploit at the end of the day in this process? A view that in the growth space, and especially in the disruptive growth space, the higher earning growth space, there is a disconnect between what the market typically assumes and what the opportunity these real disruptors can create. Typically, and I was an analyst when I started my career, the market will try to forecast the next 2 years and then begin to assume some kind of reversion to the mean, a normalized growth rate. What we're looking for in our positions, our holdings, is a divergence. We believe that the positions, the companies that we invest in will either have a more durable or longer duration growth profile to the growth, or the magnitude of the growth may be larger than expected, or some combination of the two. In terms of our process, we're looking at the end of the day for catalysts for inflecting growth. It could be a new product, it could be a new service that is attracting a tremendous amount of attention in the marketplace. It could be a new, offering new services, new capabilities. It could be disruptive to many incumbents. But we need to see that catalyst, that inflection in an accelerating growth as an indication that there's something here that is new, different, better, and exciting. We look for sustainable competitive advantages. That can be anything from proprietary technologies, patents, a network effect, a economy of scale that is very hard to replicate, a speed to market, our first mover advantage. And of course, we'd actually, even as growth managers, we do think about valuation. We want to make sure that we're not overpaying for these opportunities at the front end. So The portfolio itself, flexible, high conviction, global, 35 to 45 holdings, intentionally concentrated, with no constraints around sector, industry, region, intentionally, because the minute you impose any kind of constraints, I guarantee you, as I've done this and seen it happen, that eventually you bump into the constraint. And when that happens, you're implicitly saying, I have to, though, go and invest in the second or third or fourth best idea rather than the one I really want to invest in. So no constraints around sectors or country. The only guideline that we impose upon ourselves is that no single position goes past 10 years. And with the benefit of 20 years of history in this strategy now, it's only happened with 4 stocks. Apple in 2011, Tencent in 2017 out of China, Tesla in 2021, and Nvidia last year. So you see the stocks that really have these massive game-changing opportunities don't come around every day, and you need to make sure that you're in those stocks in a growth portfolio environment to ensure that you can drive alpha over time. The portfolio itself, typically position sizes are based around our perception of risk and reward. We look as low as $5 billion in cap, although realistically speaking, we're going to be investing probably $10 billion and higher. And at the moment, given the market environment we're in, we've been dragged up more towards the mega caps. But there's nothing special to say that that remains that way forever. We want to maintain the flexibility. Our new name turnover is actually closer to the 40%. I argue it's 35 to 45. And that's intentional because we do need to make changes from time to time. And I'm going to come back to that in a minute. And then from a portfolio risk standpoint, it's important, especially in this sort of a concentrated environment and portfolio, to keep an eye on risk in general. The biggest aspect of our risk management comes at the portfolio level, the work that the fundamental analyst undertakes to understand the business model, the risks to the model, and the valuation. But then we also do a lot of work around correlation. And I get a report every week that looks at the correlation, pairwise correlations across the portfolio by sector and across the portfolio as a whole. And this helps ensure that as we construct the portfolio and evolve the portfolio, we're not unintentionally adding exposure that is duplicative, that is increasingly highly correlated. And if something like that starts to happen and we start to see the numbers in a sector or the portfolio rise, we need to dig into those numbers and understand where those pairs are that creating the correlation issues. And then we can take some steps. If we want to add more to a particular sector that's highly correlated, we've got to take the capital from that sector in order to not further exacerbate it. We also then focus on a bunch of other variables as well. We think about the underlying drivers of alpha. We want to make sure that over time, the bulk of our alpha is coming from idiosyncratic stock-specific risks, not factor exposures, not currency, not country. And it does over time. We look at style analysis to ensure that even as we change the names embedded in the portfolio, that we still have the look and the feel of the growth portfolio, and we do. We look at upside-downside capture just to make sure that we don't have any real outliers that are starting to change the dynamic. So there's lots of things that we look at over time to ensure that the portfolio hangs together and looks like it should and delivers the kind of profile that our investors expect. It's not a buy and hold approach by any means, although it's also not a high turnover approach. We have to be responsive and recognize, though, that things change over time. When the Chinese government took a much more, let's see, what's the word I want to use? So let's just say a much more antagonistic view towards private enterprise starting in 2020, we needed to exit our overall direct Chinese holdings, and we did over the following 9 months, right after they pulled the Ant Financial Group IPO in September of 2020. When interest rate environment changes from near 0 to 4+, we do have to take some action in the portfolio, and we did. And of course, if the fundamentals change, business models change, products become a little more mature, or someone else arrives on the scene with a competing product, we need to be taking action, and we do. So this is by no means a stick your head in the sand and ignore everything for the next 10 years. The holdings have to earn their place in the portfolio every day, every week, every month, every quarter, every year. And a lot of our holdings do go on to be multi-year holdings. We also know that the bulk of our alpha comes from holdings that have been in the portfolio not just 2 or 3 years, but actually 4+ years. So it is a medium to long-term portfolio with the recognition that it's not a static market and we take action when we need to. In terms of the opportunities we see today, you're always going to likely see larger exposures in technology and a broad swath of consumer. because those are where the innovation really takes place. It's where the regulations are relatively low, where the capital intensity is relatively low. So if you think about today, generative AI, transformational technology, chips that are creating the opportunity, the foundation for AI, you're going to see exposure there. In the consumer space, direct-to-consumer, brand-oriented businesses are really attracted to us because they're harder to replicate. They have their finger on the pulse of consumer demand. They have better control over inventory and pricing. Areas of interest. Industrial is actually a come and go kind of category for us, but there are some really interesting opportunities today involved with the reshoring and onshoring of supply chains into Europe and into the US with energy transition and the like. So we have a little bit of exposure there. Healthcare, the biggest driver today is all around GLP-1s and obesity drugs that are increasingly prevalent in the marketplace. And then emerging markets. Our emerging markets can ebb and flow depending on opportunity, but there's some really fascinating businesses in e-commerce, in fintech that are taking place in the emerging markets, especially in Latin America, that we have exposure to and have had for quite a number of years. Just quickly wrapping up the portfolio, obviously managed by myself and Mark going back to 20 years. Rebecca Irwin joined us about a year and a half ago as a manager on this strategy, but she's actually been at Jennison longer than we have. She was an analyst for a number of years in the consumer space, contributed a huge amount of success to our performance in consumer names and in luxury brands in particular. And so we invited her to join us 18 months ago, and I have to say it's been a home run. Very, very pleased and excited to have her on the team with us day to day. And then the firm itself, 1969 founding, it's been around for quite a long time, has its roots in growth investing, although over the years it's broadened out into a number of different asset classes and styles. $214 billion in total AUM. Our global strategy that is part of this great new platform is approximately $18 billion in AUM. And we're usually quite proud about our client base. Client relationships are important to us. It's been said before in some of the comments. It's about people. It's about relationships. And not only is it people within the firm, but it's our relationships with our clients. And you can see here, 11% of these clients go back almost to the founding of the firm, 30 to 50 years. We have a large contingent of 20 to 30-year clients, large contingent of 10 to 20. So it is important to us to build relationships, to have the right people, and to have those conversations with people across the table about our strategy, about the ideas in them. And that has made for a fantastic 20-year product that I'm as excited to be a part of today as I was when we started it in 2004. So with that, on to the next person. Thank you.
Insightful indeed. Thomas, thank you so much. You know what? If you don't want to go back to the US, you can just stay here. We'll put you up in Pretoria. Thank you so much, Thomas. Let's give him another round of applause. Thanks so much. Now, soon we'll have a panel discussion. Don't forget to scan the QR codes on your table so that you can also take part in the discussion, ask some questions later on, and also enjoy some of the comments. Also, please join me in welcoming our next speaker, Chris Elliott, Portfolio Manager from Evenlode. Evenlode focuses on finding high-quality businesses around the world, creates Curate Global Quality Equity Fund. We're going to welcome Chris onto stage. Let's give him a warm round of applause. The stage is yours.
Right. Hello, everybody. And firstly, I'd really like to thank the Curate team and Ray for the very warm welcome we've had in South Africa. It really is a fantastic chance to come out here, and we very much appreciate it. So, we come from somewhere slightly different. This is not the Evenlode barn. We've got a very similar barn, but we're based in the Cotswold countryside. It's an area of absolutely outstanding natural beauty and really classical English landscapes. Our company, Evenlode Investment, is named after a river which has gradually shaped those landscapes over many, many years. And similarly, we are dedicated to putting together a portfolio of resilient and high-quality companies that we believe can deliver for investors over the longer term. It's not a new strategy. This is something we've been running since 2009, when Hugh and Ben founded the first of the Evenlode funds. But it is something we've extended out into both a global income and more recently a global equity strategy. The Curate Global Quality strategy will be run by James Nodler, Christina, and myself. Christina is here as well, and you'll get to talk to her later. The success of our approach has enabled us to build both the team and our assets under management, but more importantly, it's also given us the capacity to give back to society. So we have the Evenlode Foundation, to which we donate every year up to 20% of our profits, and that goes to charitable giving and early stage philanthropic investment. We're employee-owned, and we're fiercely protectable as that. We think that's the best way to deliver on our promise to investors over the long term. And to give you a better flavour of that, please enjoy this video.
The Curate Global Quality Equity Fund, managed by Evenlode Investment, focuses on long-term capital growth by investing in high-quality, cash-generative companies at sensible valuations. All of Evenlode's strategies share a unified investment approach and draw on the extensive research of the entire investment team, who have built up a wealth of proprietary data and insight that is permanently stored and easily accessible on their in-house investment platform called Eddy. This, along with open, evidence-based discussions, help the portfolio managers to make well-informed investment decisions. Additionally, Eddy is equipped with features that support the team across all aspects of the investment process, including modelling tools, portfolio oversight, and engagement and stewardship. Evenlode sees equity investments as partial ownership stakes in real companies. Over time, the fundamental performance of these businesses and their ability to compound free cash flow will dictate returns for shareholders. As such, the Evenlode investment philosophy is focused on 3 key disciplines: identifying high-quality companies, investing at sensible valuations, and diligently monitoring business risk. Evenlode defines high-quality companies as those that can sustain high returns on invested capital for a long time. These businesses share 3 key attributes. They have a durable competitive advantage and pricing power. They operate in markets with structural growth drivers, and they invest to incrementally improve their competitive position. Companies with high returns on invested capital are often asset light, meaning that they generate significant cash flows relative to their asset base. This gives them the ability to continually invest at a high rate, which creates a virtuous circle of compounding cash flows through economic cycles. The investment approach focuses on the active management of business risk to ensure this compounding potential is not interrupted. Valuation risk and liquidity risks are also monitored closely. The portfolio is incrementally nudged into the better value opportunities and away from the more expensive ones. The risk monitoring is enhanced by a proactive approach to stewardship and engagement to encourage positive change. This disciplined approach helps Evenlode to promote portfolio resilience across a wide range of macroeconomic and market conditions. In summary, the Curate Global Quality Equity Fund offers investors the opportunity to access a portfolio of high-quality companies that can generate long-term capital returns, with active risk and valuation management at its heart, managed by the disciplined, multi-generational team at Evenlode.
Great. So, as we say in that video, what we're looking to do is find those high-quality cash-generative companies and invest at sensible valuation. But you'll hear many different portfolio managers talk to you about quality, and everybody has a slightly different definition. So, to really bring that to life, we've done a number of studies, and this is one of them that we talk about a lot. We took all of the MSCI World constituents over the past 20 years, and we looked at discrete 5-year calendar intervals. And we divided them according to high return invested capital businesses and low return businesses, with a cut-off at roughly the weighted average for capital. Now, what we found was somewhat surprising, and probably something you won't hear too often from a quality manager. But the high return on capital businesses really barely outperformed at all. A very, very minor difference. So it's a question, what's going on here? And okay, how's that going to work with the quality strategy? Well, if you then look at what actually happened to those businesses over that time period, you can see about 2/3 of those high return businesses managed to preserve those high returns on invested capital over that time. And on average, these businesses returned about 13% per year to shareholders. That's a pretty good outcome. Unfortunately, within those high return on invested capital businesses, there's also about 1/3 of those that take the red escalator down. It's becoming low ROIC businesses over that time period. And these businesses, for investors, well, they stuck. I think it's probably the right way to phrase it. Only a 2% return per year. And that makes sense. The fundamentals of these businesses have materially declined. But also, the market understands that. So there's a re-rating down. And as investors, you definitely suffer. So what is it we're trying to do as quality investors? Well, it's really simple. All we want to do is pick the businesses that stay in that top bar for as long as possible and try and avoid the ones that take that escalator down. And the better our hit rates of finding those top quality businesses, the better our returns over time. And you can see in the table on the right-hand side, if you can hit the 90% hit rate, you'll end up with about 12.3% historically on average. And that's a really significant difference in comparison to a 50% hit rate, which is about 8.6. Now, Evenlode funds, on average, we've managed about 80 to 85%, which we think is pretty impressive, but there's obviously still room to go. Why does that matter for investors? Well, obviously, if you combine those rates with the joys of compounding, over 20 years, you get a really significant difference in the total return to investors. So that's the theory. But how do you do it in practice? Well, we look at the 6 key factors split between quantitative and qualitative. In terms of quantitative, highly profitable, asset-light businesses with limited leverage. These businesses have the cash flow that they can use to self-fund their growth over time. In terms of the qualitative side, there are some things that just make it easier to preserve that return on capital. If you have structural market growth, some sort of demographic driver, it's obvious you're going to find it easier to get more opportunities to get a return on that capital. If you have a durable competitive advantage, typically network effects, switching costs, or a consumer brand, then it's easier to over-participate in that growth. And finally, a continual reinvestment behind that competitive advantage means you can then improve it at the margin and get a real compounding effect across all 3. So that's one side in terms of the opportunity. But what about the risk and that red escalator of sort of bad results? Well, we look at every company in our investable universe and across our portfolios through our own proprietary risk framework, which looks at these 10 risks in particular. Every time we hear new information on a company, or we speak to management, or we learn something, or even something happens in the wider economy, we think about what it means for the company through this lens. This enables us to dynamically change our position sizes to reflect the level of risks the company faces, and therefore give ourselves the best possible chance on a weighted basis of staying in that top 3 bar. The consequence of this is it means we to put together a portfolio which is better on a return on invested capital measure, and in respect, also better on a revenue growth measure, gross margin, with lower leverage, lower carbon intensity. And we think this positions us fantastically to deliver excellent long-term returns to investors for as long as we possibly can. So that's it. So thank you very much, guys, and speak again soon.
Thanks so much. Now, John, Thomas, Chris, and Christina will now be joining us for a panel discussion. Christina, I'd also like to acknowledge you in the room. Thank you so much for joining us. They're going to be on stage. We're going to do a panel discussion navigating the global markets with value, growth, and quality. We're going to get the team to bring those chairs on. Why don't we give them a round of applause, carrying those heavy chairs? We're going to get them on to get ready for the panel discussion. After the panel discussion, as I mentioned earlier, we want you to scan that QR code in order to stay engaged with us. Natty Harrison, head of Curate Distribution, she will be moderating the discussion and answering some of those questions that you might have. I think post some questions, really engage. This is your opportunity. Natalie will give you a chance to engage with some of those points as we are taking you through Mentimeter later on. So scan away for sure, and we'll give our panel an opportunity to engage. Let's give them a big round of applause. Thanks so much for joining us.
Thank you so much. It's so great to be here and to have amazing capabilities here on the stage with me. I suppose just as a summary of our global strategies, unfortunately, of course, Robeco is not here. But a question that I often get in the market is why do we have so many equity funds, global equity funds? And it's because of the client demand. On the Robeco side, we've got core holdings. So if you think Robeco's strategy, if you want a diversified exposure to global markets, whether it be developed markets or emerging markets, you want a low-cost access to that. You want a passive alternative strategy. Robeco is the strategy for you. But if you're wanting to really take advantage of style sleeves within portfolios, you want to either combine value, growth, and quality, you want to use it just as those three, or you want to do it as the core component of Robeco with the satellite positions of active managers. These are the guys for you. So I've got four panelists from Evenlode, Lyrical, and of course Evenlode, Lyrical, and Jennison. So firstly, you've heard a lot about the strategies, or you got a bit of an insight into these strategies. So I thought let's first give an insight into what makes you guys different. So there's amazing global managers, obviously, are already available in South Africa. Global has become quite a talking point these days. Why? For a few reasons. Regulation 28 has obviously increased the access to or allowed you to take more money offshore. Another reason you guys know is that there's a little or less opportunities in the South African market from a listed perspective. Hence why even our local funds have access to global strategies too. But also clients are becoming global citizens. You know that. We've got clients, we've got a client here who lives in South Africa and also lives overseas. So clients are becoming global citizens. So you must make sure that you have strong global capabilities to meet on those needs. So now you guys, you're very differentiated in your investment approach. We've selected you guys for your unique skill set, being growth, quality, and value. And as I said, we've got amazing opportunity or amazing managers already here. But why should our valued clients choose you guys over what they're already using within their global portfolios? Let's go
down the line here.
Yeah.
So I think of our differentiation points really around two things. One is the research and the research team. I mentioned that our analysts are very, very tenured. They come to us when we need to hire more analysts. They come to us mid-career with a lot of inherent experience, and then they typically stay with us. But we have analysts who have followed companies, their industries for 20 plus years in some cases, in many instances back to companies' IPOs. And it just provides a tremendous context in which to analyze the day-to-day, quarter-to-quarter, year-to-year attributes of a business model, products, and services. So research is one differentiation point. And the other differentiation point is that sell discipline I mentioned. And it's important to realize that, yes, there's the competitive dynamics that are changing, and we would take into account the need to trim or sell product maturity. But the other point of differentiation, which I didn't mention, is one around valuation. While it's important to understand the valuation on the inbound, we will never sell a stock purely based on valuation and a perception of valuation. We may trim a stock and reduce a position, try to lock in some of the gain, de-risk it a bit, but you never know, especially in a dynamic growth stock environment, you never know when the next revenue stream, the next new product capability, the next new market that this firm may enter may emerge. And so we want to extend that. It goes to that duration of growth issue I talked about. We want to make sure that we let our winners run and that we maximize the opportunity set as the managers of the business run that business. So Valuation is important. We will use it to trim once we own something, but we will not sell based purely on the valuation to zero. I'll bring it back to our uncommon combination of value and growth. If you look at Lyrical versus other value managers, on the value side, I think over the last decade, what we've seen is a lot of quote value managers have started to own things like big tech, and you see the PE multiples creep up, and that's not something that we do. We do trade for 10 times earnings, so we are very clear that we will give you that value exposure that I think you very much want today. Now, relative to more traditional value managers that trade for those low PE multiples, we've got more earnings growth, we've got more quality. And I'll give you some examples of why. When you think about our quality focus, there are a number of industries that we don't invest in as a rule that you will find proliferating across our competitive set. For example, airlines, pure commodity businesses, they're capital intensive, and it's very difficult for those companies to sustain goods ROICs, so we skip them. Because of our focus on analyzability, there are a number of industries we won't invest in. First of all, anything that is a clear disruption threat. I mean, you find that all over the cheapest quintile. Traditional media businesses, brick and mortar retail, we don't invest in those companies. One thing that's a huge differentiator for us versus global value peers, we don't own banks. You will see them across most of our value peers, not just one bank, but many of them. And we think ultimately, the CFO of Citigroup might not actually know what the assets on his balance sheet are. And more importantly, there's a huge interest rate bet to getting a bank investment right. And we're not macro guys, so we would rather own Ameriprise, a business that double-digit earnings growth and is much, much more simple than a large bank. So that's the way I think about it. It is an unusual combination of that value and grow.
Awesome. Yeah. Well, I agree with both of those things. Research and valuation discipline is definitely important for us at Evenlode as well. I would say what's different about Evenlode, and my previous career was in academia. Evenlode is not a tenure culture. It's a very collaborative and team-based approach. The company is very small. We are all owners in the business. We are all incentivized to work hard from day one and take responsibility. Bas?
Yeah, I mean, the other thing we really, even though everything we do is aligned to long-term needs of our investors. So our ownership structure with the employee ownership is designed for us to be there for a long, long time and not forced out by anyone else. So we will be doing what we said. And our valuation methodology is a very long-term focused method, focused on how long businesses would deserve their returns with less capital is the future. What that's designed to deliver is a really stable set of returns for our investors over a long period of time. Really, everything about business is set up with that in mind.
Awesome. Thank you. I think what's interesting is that whilst these are very differentiated investment styles, there's one or two commonalities that I've picked up throughout. Number one is how long you guys hold stocks. All three of you, you don't trade your portfolios. Another area is the fact that you're really aligned with your clients. Can you just explain your alignments in terms of your various portfolios or your businesses? How you invest alongside your clients?
I think what you're getting at is our own stake in our businesses and our portfolios, in our return streams. The team at Jennison invests in our mutual funds in the U.S. very heavily. It's the biggest sources of our financial liquid net worth. We're not a partnership. Our ultimate parent is Prudential Insurance Company, Prudential Financial of the U.S. But the way around not having a truly owned firm is to instead invest alongside our clients very heavily in our funds. And just a separate comment here, the U.S. SEC makes it very difficult for portfolio managers to actually own individual stocks, just given rules around holding periods, trading, and the like. So from our perspective, the best way to own stocks that we would like to own is to own our own funds, because our funds own what we would otherwise own ourselves. That's how we think about that topic. The easiest way to answer that is that the 3 PMs at Lyrical, the vast majority of our net worth is invested alongside you, potentially, in our funds. The only thing we own outside of Lyrical funds would be some real estate. So we don't have a great hedge against value. That's where we place our bet. Yeah, I mean, exactly the same at Evenlode. We encourage all of our employees to co-invest, but yeah, the portfolio managers have to do their savings in their own funds. So yeah, we share in the good sides and the bad side.
Awesome. Let's talk about stock picks. Christina, I know when Chris already alluded to those 6 characteristics when you're picking a stock, on the qualitative side and the quantitative side. Could you just give some examples or 1 or 2 examples of a particular stock that would go through that investment screen?
Sure. So we like companies with strong competitive advantages, but what we like even more is companies with widening competitive advantages. And one example that we initiated a position in recently is Lindt, the Swiss chocolate manufacturer. So Lindt has been growing organically revenues at 8% historically for the last 10 years. And we think they have a good runway for growth to do that for another 10 years. So in developing markets, chocolate consumption is not as high as in developed markets. And there's a correlation between GDP growth and increasing chocolate consumption. And Lindt is very well invested to take advantage of that. So they're one of the very few consumer goods companies that during the pandemic, they didn't cut back on advertisement and promotion. They stayed very well invested. So stayed top of customers' mind. Their margin currently is something like 15%, and they're growing that at a very steady rate, so sort of 20 to 40 base points per year. And, they sell those Easter chocolate bunnies. It's a lot of air in those. There's not a lot of chocolate. Like, they make margin, but they're choosing to invest that in advertisement and promotion to gain a share in all of the white space that they have in emerging markets. Another example that we initiated a position a couple of years ago is Hermes. So they make the Birkin bags, the luxury French conglomerate. And again, it's a very strong, intangible asset, very rich heritage behind the brand. It's very hard to reproduce that. And for a brand like that, the tricky thing is not to get greedy because there's a temptation to try and sell as much stuff as possible to as many people as possible. And from our analysis, compared to their competitors, Hermes has not been increasing their distribution. They haven't been widening their distribution, but instead they're going deeper. So they're deepening their relationship with existing customers and building on the loyalty they have with existing customers.
Awesome. Thanks, Christina. What's interesting for me with these 3 portfolios is fundamentally what you'll understand is that the crossover of stocks is minimal. So across all these 3 portfolios, I looked yesterday, I think there's only 8 stocks. Obviously not across all 3. That it's interesting that if you're wanting to have a globally diversified portfolio, you really aren't going to have that if you have to go buy these 3 stocks. Hermes is actually just one of them that Jennison also holds. Now, John, I'm going to direct this one at you. I love that story you told me on Broadcom. So I think it really explains the way that you guys think of value, that unique process of buying cheap, but looking at return on invested capital. So could you just, I think, share with the audience that story?
Yeah, sure. So Broadcom, you probably have heard of it now. It is a darling, and for good reason. It's a major AI play, and we don't own it anymore. But it was one of the best investments that we made at Lyrical. I'll give you a sense for how we operate. Now, we bought this stock in 2013, and at the time it was a specialized maker of semiconductor chips. And it had a history of growing its earnings at a double-digit rate. And over the decade or decade plus that we owned it, grew its earnings at a 30% plus rate, even though we bought it at about 13 times earnings. Now, luckily, over the 10 years that we held it, it never really traded above 15, 16 times earnings. It never hit our estimate of intrinsic value. And so we held that stock the whole way. Now, the narrative is interesting because you can see how if you really have that long-term investment horizon, our average hold period is 7 to 8 years. You can watch how if you buy quality business really cheaply over time, their narrative will shift. And so in the case of Broadcom, it went when we bought it to basically what people thought of was a fraud. Here was a company, you might have heard of a company called Valiance. What they were doing was they were buying drug companies and they were killing the R&D departments and juicing their earnings. And it was not a good thing to do because you kill your future growth if you kill all of the R&D. And people looked at Broadcom where these earnings were going up 30% a year, and they were doing a similar thing. They were buying chip companies and slashing R&D spend. And our research there was to say, hold on, let's go in and really see if this is true or not. And what we found actually was quite different, which is what Valiant was doing. Oh, sorry. What Broadcom was doing is they were going and buying these chip companies because they had a core chip that had a 70% type market share that was dominant. They really liked that one chip, but they realized these smaller chip companies, they were investing money to try and grow with lower returns in areas where they didn't have expertise, or they didn't have the competitive edge. So they would cut the R&D department, but they would cut from non-core chips and actually invest more in the chips that mattered. And so actually the competitive advantage of the chips they were buying was growing over time. And so we thought that indeed this was actually a very sustainable business. Now, fast forward to today, we sold the stock earlier in the year as it crossed about a 20 times PE multiple. And of course, we sold it too early. But that's our approach. And our sell discipline is to say, look, we have a job. It's let's go buy stops in the bargain bin. Most of them are bad, but every once in a while, there's a Broadcom. Let's do work on that and let's be patient. And when that stock reaches a market type multiple, we'll sell it. A growth guy can buy it and might have a great experience with that, but that's not really my job. My job is to say, I don't really know what the AI growth is going to be for Broadcom, but I can find something else in the cheap market, in the cheap part of the market, and kind of rinse and repeat.
Awesome. Well, I think it's great segue into sell discipline. You heard earlier Tom talking about one of their differentiators is their sell discipline. So I see we run out of time. I'm going to throw this one quickly at you. You alluded to earlier your disciplined approach of selling out of China. Give me another example of that sell discipline, because obviously sell discipline and growth styles, I think, is exceptionally important.
So Tesla, I mentioned, was one of our 4 stocks that actually hit our 10% cap. That did so back in late 21. And we sold the last share at the very beginning of this year. And in that intervening period, we took it from 10% pretty steadily downward to that final sale. And the reasons for that was after many years of being pretty much the only game in town for EVs, you actually started to see some viable, decent, competitive product out there from other manufacturers in the hybrid space and in the BEV space as well. And Tesla's response to that was to begin cutting prices because they had the room, the capacity. But that means that our analysts had to go back and recast the financial model, make assumptions around lower margins going forward. And obviously that has an impact on valuation. So the first series of cuts came as the competition started to emerge, as the models had to be reassessed and redrafted. Then you will recall that along the way, Elon picked up or purchased Twitter on his own. He financed a portion of that purchase with his shares of Tesla. So then we went through a period of a steady drip of sale pressure on the stock as he kept pushing more of the stock out the door to meet his financial obligation in the purchase. Along the way, he also, for whatever reason, seemed to increasingly make a bit of a shift to the right from a political point of view. And you can see today he's gotten quite extreme, which is a little ironic because most people who are interested in electric vehicles are probably not that direction. They're probably that direction. He's also made some rather disparaging remarks about women, and more women than men typically buy Teslas. So this combination of all these factors emerging along the way had led us to just continue cutting, and eventually exiting that position the last few shares at the end of this year. Now, I will admit to you, the stock has actually moved higher since then. We won't know whether that decision ultimately was the correct one or not. But obviously the process, the rationale was sound. And we know from our analysis and our data that over years 3 and 5, post a final sale, we typically outperform both the benchmark, or put it a different way, those stocks that we sell underperform the benchmark and underperform our portfolio as well. So only about a quarter of the time do we actually end up being wrong to have sold. So will Tesla fall into the right decision or not? Time will tell. But we do keep track of that as well in our process so we can understand those dynamics going forward. But that's an example of something that we made a tremendous return. Actually, it's our second best returning stock over the trailing 5-year period, but it's no longer owned because of the shift in fundamentals, shift in leadership perspective and some of the actions of the CEO, and it's no longer in the portfolio.
Awesome. Thank you. Thank you, guys. I see over time. I'm literally going to ask one question. It's just the Evenlode team. Quality is, and it's one of the questions that have come up here, is quality is one of those enduring styles that obviously provides the stability in the portfolios. But how do you offset or provide stability and as well as deliver alpha for clients? How do you get those right?
Yes.
So you can be quick.
Yeah, it's very quick. So it comes back to the sort of twin disciplines of our risk management framework and our valuation approach. We really want to deliver that sort of smooth ride for investors over time, because we know that the clients of our clients have to talk to somebody and justify exactly what's going on. So when the markets are up, they want to be able to say, this is how the portfolio is behaving, this is why the portfolio is behaving this way. We'll always write a lot of content that'll be available for you, the Curate platform, just to make sure you're always in contact and understanding your thoughts and approach you take.
Awesome. Thank you. Thanks, everyone. And thank you to guys. And thanks for coming all the way down from US in the UK. An informative discussion indeed. Let's give them another round of applause. Thank you. Christina, all that talk of chocolates has left me really nibbly and hungry, and I think it is time now for a comfort break.
Highlights. Everything was a highlight. I couldn't be happier. I couldn't be prouder. I think we had amazing attendance. People are so excited. I think we managed to break through the clutter.
To see 2-3 years worth of work come to what we've just seen throughout this week. We've seen over 500 clients. We've taken these global managers to see financial advisors, DFMs, direct clients. It's been absolutely phenomenal. The feedback we've gotten has been, it's fresh, it's different, and that's exactly what we intended. We wanted it to be fresh, we wanted it to be different, and I'm very excited and very proud of actually of what we created.
This is a part of creation, a part embedded in curation. This is the whole manifesting the imagined reality of Curate.
To curate any exhibition requires comprehensive research, knowing your individual client's tastes, and understanding what shapes and drives their behavior.
Now that makes a pretty picture.
It's interesting. It's really bold.
I agree. The attention to detail is quite something.
You can see how much work went into it.
Somebody's going to be very happy to have this.
Boss, you need to look at this. This is truly amazing.
Handpicking the right artist to create a unique experience. That's what sets Curate apart.
I can buy this.
This is Curate. This is the art of investing. We handpick the best local and global fund managers to offer you an exceptional range of investment funds for your every need.
Curate is an independent global investment manager with a unique range of funds. Each one is managed by a team of highly skilled people that we have handpicked from top managers around the world to look after our investors' money. We curate each fund to meet a specific investor's need, and we have conducted thorough research to find the people that we believe are most suited to deliver on that.
At Curate, we believe in keeping things simple. For our investors, we take the complication out of trying to pick which funds you should use by providing a comprehensive range that reflects your needs.
The teams we choose to be our long-term partners must show professional integrity, loyalty, and alignment with our values and expectations. They must have a track record of delivering returns for investors, the passion to always give their best efforts, but also the humility to admit and learn from when they make mistakes.
Ultimately, we believe that the art of investing lies in simplifying things. In a market where there are now thousands of different funds to choose from, we give investors a comprehensive range of options. This provides them with access to different strategies, all in one place. It also gives them the comfort that each fund is being managed by a team that has been handpicked through a detailed research process.
We start by identifying the kinds of funds that investors require to meet their different objectives, such as saving for their future goals, investing for the next generation, or building a comprehensive global portfolio.
Being part of a group that has research teams based both in the United Kingdom and in South Africa, we have a global reach that allows us to find the best people, wherever they may be, to manage our funds.
We set the bar high so that we know we can trust those we select to look after our clients' money.
Each fund is curated to have a specific profile in mind, with the understanding that the best way to help you meet your goals is to make sure that you get as few surprises along the way as possible.
Our research team has decades of experience, deep relationships across the industry, and a global view that means whether we are looking for managers in the US, Europe, South Africa, or anywhere else across the world, we hold them to the same high standards.
Our investors have reassurance that they don't need to search through thousands of different funds to find the reliable and trustworthy managers, because we've done that on their behalf. It's all part of giving investors access to the very best investment ideas. So why consider Curate as your investment manager of choice? Firstly, because we believe in having an investor-centered range of funds. Each of our funds is designed to meet a particular client need, such as saving for your future goals, growing wealth for your children and grandchildren, or ensuring that you have a balanced global portfolio.
We also believe in simplicity. We will always be transparent and keep things relevant so that you face as few surprises along your investment journey as possible.
We have a global reach. We research managers across the world to find the people we believe are most suited to delivering on what our investors require, wherever they may be.
And we believe that the best people have the highest standards. The people we handpick to be our long-term partners must offer something unique and show integrity, loyalty, and a record of delivering returns for our investors. Isn't that stunning? Speak to us today or go to curateinvestments.com to find out more about Curate or the art of investing.
Highlights. Everything was a highlight. I couldn't be happier. I couldn't be prouder. I think we had amazing attendance. People are so excited. I think we managed to break through the clutter.
To see 2-3 years worth of work come to what we've just seen throughout this week. We've seen over 500 clients. We've taken these global managers to see financial advisors, DFMs, direct clients. It's been absolutely phenomenal. The feedback we've gotten has been, it's fresh, it's different, and that's exactly what we intended. We wanted it to be fresh, we wanted it to be different, and I'm very excited and very proud of actually of what we created.
In the beginning was imagination, showed itself in creation. Time warp to the beginning, to when curiosity as a child got the better of you. In the childlike state, you never needed to search for creativity. It manifested itself in whatever you touched. All was a blank canvas, waiting on you to bring life and be life. The beauty of creativity in adding, subtracting, breaking, bolding, with the untrained confidence of a child that knows no limits. That creativity bears purity in its fearlessness, with an innocence in that I don't see anything go wrong approach, in its restless readiness to transform anything in its hands, for it cannot conform to the norm. Break to bold. Creativity knows no failure. This moment is no Benjamin Button experiment. Revisit the past to transform future successes. Evolve in real time. There are ones who have cocooned from the hood of child to board the ship of curator. Remember your center, the investor. You are here, anchored by your commitment and passion to deliver on what investors require. Do not abandon the inner child altogether. Imagination is a gift. They who possess it know its magic. They who use it know its power. A blank canvas awaits your awakening daily. Time warp to the now. Who are these ones whose creative prowess I allude to? For surely one does not need to kiss a lot of frogs to find a handsome prince. When Curate has picked by hand the best people, extraordinary people to look after money, in their hands they carry with care the best they have collected to put on display, the mark indicative of a truly good curator. There's a transparency in their glide, straightforwardness in their stride. Expect no surprises with what is entrusted unto them on any journey. They've harnessed their skills and expertise to distinctly approach the I's to be dotted and the T's to be crossed. To search for special opportunities, find gems amid the junk, use disruptive ideas to drive growth. Against such, there is no law. Results attest to their imagination, returns evidence their execution. Who are these ones I speak of? These ones are gathered amongst us here at the Galleria, among many in the world handpicked for the cause. You are the called and the chosen for this curation. Who are you not to be? Who are you not to be the best? Cause your cause with a singleness of purpose. Possibilities stretch as far as you allow. This is a part of creation, a part embedded in curation. This is the whole manifesting, the imagined reality of Curate.
Let's give it another warm round of applause. Emma Mevier. Wow. What a break it was indeed, ladies and gentlemen, as we are transforming the room. Well, once again, a warm welcome to each and every one of you. I'd like to welcome our next speaker onto stage. Now, Karabo is a portfolio manager within the Momentum Investments fixed income team, and she will be taking us through how her team focuses on delivering low-risk inflation outperforming returns for their clients in the 3 income funds that they manage for Curate. Let's give a warm round of applause as we hear from Karabo also about our value-based approach to income investing. Thank you.
Good afternoon, all. I've been tasked with the responsibility of introducing the Momentum Fixed Income team's capability to you today. And I'd like to start this by telling a quick joke, just housekeeping. It's impolite not to laugh. So there's 3 rooms. Each room has a bucket of water, and it also has a trash can that's burning up. An engineer enters the room, looks at the fire, looks at the water, takes the entire bucket, throws it on top of the fire and says, "I'm done here, I'm out." Very glad Robeco's not in the room. The next room, a mathematician walks in. He looks at the fire, he looks at the bucket, looks at the fire again, he looks at the bucket, and he's like, "Why am I here? A solution already exists to this problem, I'm out." Third room, a physicist walks in, looks at the fire, looks at the bucket, takes out a piece of paper, he calculates how much water he needs to extinguish this fire, measures that quantity, drops it on the fire, doesn't waste a bit of water at all. So okay, just one point, you guys didn't laugh. I said it's rude not to laugh. The joke's over. But my point is the physicist way of thinking. That's how I'd best describe the Momentum Fixed Income team's investment philosophy. For us, every cent matters. We are looking to deliver consistent inflation-beating returns to our investors. However, we don't believe that the potential of every cent that we get is limited to financial returns. We believe we can use the same cent to affect the lives of real people in our society. Some of the investments that do this really well is our investments in infrastructure. When you invest in rail infrastructure, you're creating a safe and affordable way for people to get to work every day. When you're investing in affordable housing initiatives, you allow people from all walks of life to live within the cities in which they are working. When you're investing in alternative energy generation, again, you are helping the country to build a sustainable, cost-effective solution for the benefit of everyone. Just to put some numbers to it, this is the impact that one of our investee companies has had in the affordable housing space. So they have facilitated the funding and the construction of 658 buildings in the inner city across 141 suburbs in and around the inner cities in South Africa. So what that essentially means is less mothers have to wake up at 4 a.m. in the morning to get to work at 8 a.m. And what it also means is that people who have been forced to downgrade as a result of economic challenges still have safe spaces within our cities to live. Now, another facet of infrastructure that we are also moving up our portfolios towards is investment in digital infrastructure. Investing in data centers, tower operators, installators of fiber cables, that supports the communications industry. And obviously we all know that this is a sector that's important for economic growth, it's important for education, and it's also important for just improving the quality of life of people that we've in our society. So we've invested alongside banks in one of the data center developers in the country, and that has essentially allowed our investors indirect access to companies that they would not be able to find in the South African market. This company rents out space to leading internet companies across the world. Not only does this have a significant diversification benefit for our portfolios, but it also has a positive impact from employment and skills development perspective. And it also has a positive community impact because these data centers are being built in neglected factory space in places like Isando. So you're essentially rejuvenating an area that's been neglected. Our investments in tower operators, that gives access to some of the leading mobile network operators across the continent and in other emerging markets. Again, a significant diversifier because you can't find that in the listed South African market. So when we think about these investments and all other investments in our portfolio, our investment philosophy remains consistent. We are valuation driven. The price that we pay is a function of the risk that we are taking on. And on top of that, it also takes into account what is our probability of a successful exit at the end of our investment period. A one-year investment is only a one-year investment if there are other investors to take you out after a year. So when we are investing in a company, we need to be confident that the quality of this company is going to improve over our investment horizon, so that there is a group of investors at the end, should we want to exit, who can take us out. Very few companies generate enough cash flows in a single year to pay off their debt obligations for the year. In constructing our portfolios, diversification is key. Not only does it allow the returns of the portfolio to be driven by uncorrelated factors, it also allows protection for the portfolio because it mitigates against tail risks when they do occur. When we measure our own performance, we measure it based on the return per unit of risk that we take on. We believe it's a mistake to look at returns on an absolute basis. You have to consider the risk that's been taken on to generate that return. You have to consider the potential drawdowns. You have to consider the volatility that you are taking on. Ray already shared the slide, but essentially we have 86 billion rand of assets under management. Our cash plus product, which is the enhanced yield, that is targeted at investors who are looking to invest for a year and less, while our credit fund, which is the Momentum Income Plus fund, that's more targeted at investors looking to invest between three years and more. And the flexible income fund would obviously accommodate investors who lie somewhere in between. So the funds in our range, they are never going to blow out the lights over any period. But what they are going to do is preserve your capital in most market environments. What they are going to do is give you returns well in excess of inflation and also above their respective benchmarks. The team that manages this portfolio has on average 13 years of experience amongst them. And also the experience base spans the banking profession, the legal profession, as well as the asset management profession, obviously. Our most experienced individual is actually our credit analyst, Nicolette. She has more than 24 years of experience. And on the lower end, we have our credit analysts, Moleboheng and Lerato, in the team as well. In terms of our process, it's collaborative in nature. We leverage the resources and the skills that we have within the Momentum Group. So the fixed income team owns the process, but we do leverage on the data origination capability that lies in the group. And what that allows us to do is position ourselves as an investor of scale in the market. And that gives us access to bespoke transactions that small managers might not be able to access. And it also enables us ongoing access with leadership teams in the private sector as well as in the public sector. Thank you.
thank you so much, Karabo. I must say I thoroughly enjoyed your joke. I'm not that brave. Let's give Karabo a warm round of applause. Wonderful. It's delightful to see so many familiar faces on the slide when you introduce us to the team. And it talks about trust in people again. So once again, thanks for being here. Up next, and I'm quite excited, Kundai Munzara, co-founder and portfolio manager at Sesfikile Capital, will now join us on stage. Now, earlier we saw Sesfikile appear on Ray's slides. They manage the Curate Flexible Property Fund, which invests in the South African and international property. So Sesfikile literally eats, breathes, and sleeps property. Their strong track record for delivering outperformance for investors is the result of its focus, and we can't wait to hear from you. Unai, thank you so much. Thanks so much.
Hi everyone, my name is Kundai Munzara. I'm a portfolio manager and co-founder of Sesfikile Capital. Our business really grows or grew since 2010 from one thing, which is really a passion for listed property and a passion for property in general terms. And I thought of this building as an image. I think for some of you who fly from Cape Town, this is the biggest distribution warehouse in sub-Saharan Africa, and this is owned by some of the REITs that we invest in called Fortress. So every time, on the weekends, I'm dragging my wife to go do property tours. I had my son in Newcastle over the weekend, and he had his first property tours because he learned how to speak, learned how to walk about 3 weeks ago. So he's in the game now. But it really comes from a real passion for the asset class, which is listed property. And the second thing we really pride ourselves on is looking for those places of differentiation within the sector, within listed property. And it speaks to how we manage this particular fund. So what does the fund do? Broadly speaking, what the fund does is it invests in South African listed property companies, but it also invests in global listed property companies. If you think of it as the two buckets, about 60% of that fund will be the local piece, which is JSE listed property companies, with the balance being the offshore space. And I'll speak about this a bit more. What we aim to do is to outperform our benchmark over the last 14 years of being in business. We fortunately have been able to deliver that for our clients in both our local and our global strategies. And we definitely are committed to doing the same in the Flexible Property Fund. Delivering outperformance of the OP benchmark and the FTSE EPRA benchmark as well in the global piece. So it's a combination of those. And for those investors who look at property, I think it's very difficult to de-link property from income. Property is a total return asset class, but income is very important. So within all that, we want to deliver good income over time for investors. Predictable income streams that grow above inflation is what we want to deliver. So what's our toolkit? How do we do that? So if you look at those two buckets in the local space, we've got an investment universe of about 20 to 26 companies within 5 sectors. So that's office, retail, industrial, self-storage, and a little bit of residential and a bit of healthcare as well. But it's all JSE listed property companies, and some of that see-through exposure is in places like Romania and Poland, so Central and Eastern Africa. But not Africa, Central and Eastern Europe. But when you look at the global opportunity set, and this is where the fund gets quite exciting because it gives you the bottom-up approach and the active trading that we can express in the local process, but it also gives you the amount of breadth and depth of opportunity set that you get in the global space. So in the global space, in South Africa, we spoke about 5 sectors. In global, we've got 16 plus sectors. So in addition to what I spoke about before, we've got data centers, we've got towers, we've got healthcare, we've got self-storage, we've got senior housing, we've got manufactured homes. The list kind of goes on. And within that, we've got about 350 companies that we can choose from, ultimately from about 8 different regions in developed economies. That's North America, Europe, and Asia Pacific. So it's a wide universe that we choose from. And within that, we end up today we only have 34 companies. So what this fund is, if you look at what we do in the offshore space and what we do in the local space, don't look at this as a simple combination of the two funds. This is our best ideas from everything that we see in the global space, whether it's South Africa or outside South Africa. What's in this fund is what we call our best ideas from everything. So what's the toolkit and what we do, how do we get there, is what we call the 4D approach. And this started from when we started the business back in 2010. So we've got a passion for direct property. I told you about my son starting his first property tour on the weekend. He's a key part of the investment team with about 1.5 years of experience. Secondly, we focus on the detail. So we want to make sure that we understand these companies intricately. Not only do we know the assets, but we also know the balance sheet. We spend time with the management teams. We try and understand everything about these companies, and it speaks to what we are. We are a property business that has a strong passion for the asset class. But you must understand the drivers. So interest rates could be a driver. Particular transactions could be a driver. Where we are in the business cycle. Potentially tonight, what happens with the election tonight could be a driver of what happens to markets in the kind of medium to long term for global markets. So we must be aware of these things. And also lastly, through our vast experience in the sector, we must understand some of the corporate action opportunities that add a bit of alpha to the portfolios. And that's what we've delivered for clients over time. Now, speaking to process, what we do is a couple of things. And this is what we do in both local and global. We try and identify themes that are happening globally. So what's a theme? In the US, the baby boomers is the fastest growing population cohort. So they're the second biggest population group and the fastest growing population group in the US. So what that means is that the demand for healthcare-based, healthcare type real estate is starting to grow. For all of us, we're starting to carry more and more data and consume and create much more data just from our cell phones. The demand for data centers is a driver, and it really speaks to how we think about things thematically. We try and mesh those themes to real estate fundamentals, ultimately to find the best stocks, the best sectors, and the best ideas that fit within those themes, and also importantly to try and avoid things that they would be disrupted by those themes. Valuation is always important. We like to buy companies with reasonable or good fundamentals, but at a reasonable price. Ultimately, what ends up in the portfolio is where we think the best value and opportunity for alpha is. So what's emerging now? So just, as I kind of close off my section of this presentation, what are the emerging themes? So from a South African perspective, I think the election outcome was positive for markets, positive for sentiment, positive for property. Property is up about 30% this year in South Africa. I think globally the best performing real estate asset class. But also we're leaning in on demographic drivers or necessity-based real estate. So as the economy starts to slow, interest rates starts to turn down, we want to focus on necessity-based real estate. I spoke about healthcare. No one consumes healthcare out of pure consumption desire, but out of necessity. We don't store things in self-storage boxes out of desire to store things, but out of necessity of running out of space. That's where we're focusing the portfolio. I think the positive impact of green energy cannot be underestimated, and the investments these companies are making are yielding returns of 15 to 20%. Sometimes it's better to invest in solar than to invest in the real estate at this point. So it's pretty attractive. And also interest rates are starting to come down, have started to come down, and that is a big one for property. So for property, you want a stable economic environment and a falling interest rate environment, and generally that's a good market for beta and alpha. Now in closing, just really what our business is. We started the business back in 2010. We've got about 18 billion in assets under management and about 16 years combined investment experience across the team. With three portfolio managers on this fund. My colleague who will be on the panel today, Evan Chankalovitz, also co-founder of the business, and Naeem Tilly, who's our head of research, and me as the guy who drew the short straw to do this presentation today. So unique characteristics about Sesfikile as our close off. We're all about property. That's all we do. We emphasize that diversity is in our DNA. And if you look across our team and you scratch a little bit further, The only thing that links all of us is that all of us are last born in the business, but nothing else, is similar in terms of our characteristics. We love property and we're last born in our families. Alignment of clients and our interests. This is our business, this is our brand, and we want to build this over the long term. And we do that by consistently delivering for clients. Thank you very much.
Kundai, thank you. You might as well stay where you are because you're part of our next panel discussion. While Kundai stays with me, Ray's going to be back on stage to host that panel discussion. We're moderating a panel called Painting the Income and Property Landscape with Karabo. Please join us. Kundai is already here. Evan, if you can join us on stage as well. As you heard earlier, Evan is also from Sesfikile. After the panel discussion, Ray will also be going through some of the talking points and any questions that you have scanned and given us through. If you've posted to Mentimeter or you would like to still do so, you're welcome to take to your phone and get through that discussion. Kandai, why are they setting up the chairs? Just one question. I didn't see your son's picture when you were showing off your portfolio managers.
Finished his RE exams.
That deserves a round of applause. I'm speechless. Let's welcome our panel. And again, please engage by using Mentimeter. Thank you.
Thank you, everyone. Evan, do you want to quickly introduce yourself?
I'm the other co-founder of the business of Sesfikile and work very closely with Kundani's son.
Thanks, Shri. Evan, Kundai and Karabo for your presentation. And Evan, welcome. Kundai, you touched on it right at the end. And I suppose no fixed income and property panel can even be complete or not be started with what you mentioned about the interest rate cutting cycle. So my first question to, I suppose, Evan, will start as you. How are you positioning your portfolios to benefit from this rate cutting cycle?
That's a great question because there's, as Kundai mentioned, two very different buckets. So globally, the lower interest rate cycle is really an indication of a weaker economy. Therefore, we want to try to avoid the cyclical movements of the general property sector and focus on what Kundai spoke about, the demographics and the consumer demand. So we position more towards the likes of data centers, more towards healthcare, senior living, skilled nursing facilities, manufactured housings, things that are not susceptible to the cycles as such. Whereas in the South African context, it's a very different story because we obviously following the US, but our fundamentals are, post the GNU are actually looking slightly better. So what we're seeing is a lot of generalist investors and offshore guys coming into our markets. And what they play is liquidity. So within the South African context, we're actually going overweight the likes of a Growth Point and a Nepi because that's where the liquidity lies. So it's a little bit of a tale of two cities, but that's how we're positioning ourselves for a low interest rate environment.
Okay. I'm going to come back to that question, Kundai, when we chat about what you mentioned now, GNU and this optimism on SA. We'll come back to that. Karabo, yourself, in terms of how you position dual portfolios?
I think for us, the position in anticipation of the event, we don't wait for the event to happen. So we already, when we're quite confident mid last year that the peak of the rate heights had substantially arrived, we started going long duration, and we have already been handsomely rewarded for that. You look at the performance over the last quarter, but the point is when we're not looking to be balanced and reposition the portfolio at all time. What we're looking for is good entry quotes. And mid last year was a very good entry point for duration trades. Yeah. Whereas the rate catching cycle would believe that it's going to be shallow, and that's what the market believes. So there's still value in having some cash. There's still value in having credit. You just have to be discerning because now you're going to use another 75 basis points. Let's say that according to performance. So you're going to have to make up if you want your performance to stay consistent.
Yeah. And in fact, just Karabo raised a good point now about the performance over the last quarter and how they benefited them. When you look at the Curate website, you'll find that the new fund currency will have very new fund fact sheets with very little performance track record, given that we've just launched the business. The fixed income funds were converted and rebranded to Curate, and those ones you'll find with a much longer term track record, and you'll see why we selected the Momentum Fixed Income Student Management. So take a look at that. Kundai, a question to you, and also carrying on from what Evan said. People always say last year's winners, stay away from them because it could be this year's user. And given property had a tough, 4 or 5 years, and then last year, for those who got caught unawares, it then had a fantastic year and it continues to do so now. Is it too late for people to get into property?
Way too late.
Really?
No, it's not. So, just kidding about that. I think if you look at, we've had this question from a lot of our clients who've enjoyed this 30% rally and maybe in this year and about 50 over the last 12 months, right? And, the answer we have for them is the following, is I think listed property had, gone through a really tough 4-year period. The sector was extremely cheap to, around kind of October last year. Sentiment was bad. Interest rates were high. Political sentiment about South Africa was pretty bad as well. And as a result of that, when interest rates started peaking, particularly in the US, and we had the advent of the GNU, it was a re-rating driven rally. So it's really driven by what's happened to properties rating relative to bonds, but also our outlook around the earnings story. So the sector has re-rated, and that's what really drove this rally that we saw. Now, if we say fast forward, are we too late? Where are we looking now going forward? The point is that we had a re-rating driven rally, but now we think we're in a good position for the sector to outperform, driven by earnings growth. So what we haven't had for the last couple of years is decent inflation beating earnings growth, and we think 25, 26, and 27, though that will reverse. Our earnings should beat inflation over the next 2 to 3 years, and we think you'll start to get decent 13 to 15% total returns from that sector. So we don't think it's too late. We actually think it's a good time to still get a good return out of property.
Can I just add, is with regards to the portfolio that we're offering to the market here, the flexible property funds, Kundar spoke about SA property, and I believe there is value in SA property, but the big portion of it, not only in the offshore buckets, but even on the JSC, the All-P property funds on a see-through basis, around about 40-50% is offshore. And if you look, that 50% rally since we call the first false start when they thought that the rates were going to be cut in November last year, we've done 50%. But if on a see-through basis, the likes of Sirius has grown earnings probably about 7-8%, but their valuation is only up, or their price is only up circa 5-6%. So the offshore component of it has not rallied by any stretch of the imagination. It's really the SA markets, but as you said earlier, it's because it came from such a low base. And now not only is it coming from a low base, but the fundamentals have turned positive.
Yeah. And it's actually also why we selected Sesfikile and gave them the mandate to manage both local and global. Because I think if you saw what happened during that tough time in the property sector, if you were only exposed to SA property alone, there was nowhere else to go. Whereas with a global mandate, I think there's a lot more, the universe is a lot wider for you guys to look for opportunity. From all of your answers, I'm hearing a lot of macroeconomic talk. So I actually wanted to ask, Karabo, I'll start with you. How important is macroeconomic forecasting in your process?
It's very important. I didn't speak much here. I was out of time at our slide, but part of that expanded resource that we have access in the group, in the Momentum group, is our research team, is our macro research team. So over and above developing scenarios and how the yield curve's going to look over in those scenarios, let's say, even at a single corporate investment level, we would look at cost performance. How correlated is the revenue, EBITDA, costs line of this company to macros, and how is that going to affect performance going forward? So it's part and parcel of every investment. It's not just our, let's say, our duration phase. It counts.
And yourselves?
Yeah, at Sesfikile, we pride ourselves on honesty. And honestly, we can't call the macros. That's not our job. Our job is saying what are the property prices implying? And is it too cheap or too expensive from what is implied in that macroeconomic outlook? To call currency, to call rates, unfortunately, we're not experts at that. And unfortunately, I truly believe that no one really is.
Okay. Differing answer. Easy. Trouble, last question for you. I want to talk about credit for a second. Within your credit portfolio, and you also touched on it briefly, but I want you to go into a bit more details. So what factors do you focus on to mitigate the risk of losses in that income plus fund?
So for us, strength of cash flow generation is key. Revenues do not pay the bills. It's cash flows that a company makes at the end of the day, operating cash flows that matter. And another one is governance. If you look at the South African markets, the defaults that we've seen is either governance failing or it's a liquidity crunch. So hence why those two are key. However, you also have to consider capital structure and also EEB structure. Some of these investments that come to the market, you're investing at a holdings level. A holdings company is dependent on dividend flow. Unless you have guarantees from the operating companies that make the cash, then that's not a good investment.
Still.
You have to get close to where the cash flows are.
Thank you. And I suppose from a property perspective, it's not so much a credit issue as it is, how do you find the quality in terms of your property investments? I suppose my question to you is, what metrics do you use to evaluate the quality of the properties that you invest in? And then also, does that metrics differ between how you look at global and local properties?
Yeah, thank you. We've got a one-team approach. So when we're talking, property, we're talking generally local and global. And in terms of how we evaluate the companies is the same in terms of that quality, whether we're looking at a REIT in Singapore, a REIT in Soweto. And the issue is when we really look at the quality of a company is really based on the quality of the underlying real estate, the quality of the assets, the quality of the management. Karabo mentioned the issues around corporate governance. That's super important for us. The tradability, liquidity of that stock. And lastly, very importantly, the balance sheet. So the balance sheet is not just a static debt to EBITDA ratio or loan to value ratio, but it's also the diversity and the sources of that funding and how hedged that book is. So we analyze that stuff. That's that second D when we talk about, detail in the 4Ds. And that's what we look at. But I think quite clearly, our process is not about investing in the shiniest buildings or the best located assets. It's what price are you getting a good quality asset that can be competitive in this micro market. And that's what we define as quality.
Perfect. Thank you very much. And thank you to Momentum Fixed Income and Sesfikile Capital, both specialists in what they do. Momentum, very focused on Momentum Fixed Income team, only focused on fixed income. And as Kundai said in his presentation, Sesfikile only is focused on property, which is one of the reasons why we selected them. The sheer focus on it is that they do and how they become specialists in that space. So thank you, Karabo. Thank you, Evan. Thank you, Kundai. And hopefully next year we'll have your son on stage. Thank you.
Not just building portfolios, but building families. Ladies and gentlemen, let's give them another round of applause. Ray, thank you so much. Sometimes the real impact of fixed income and property investments are underplayed. Well, there is a lot more than the interest rate cycles, and Karabo said it beautifully here on stage. Understanding measurable impact it has not only on the client's portfolios, but also to the economy is uplifting. Ladies and gentlemen, up next, we would like to welcome to stage our last set of speakers for the day. As you can see, the room has already been turned to blue. Our last speakers for the day as we introduce you to the Curate Equity and Curate Balanced Funds. First up, we have Patrice Moyal, CIO and a portfolio manager at Visio Fund Management. Visio manages the Curate Balanced Fund. Visio can explore interesting ideas locally and globally, both in the usual and also the not so obvious places, to find the best opportunities for investors. Their experience managing different assets and strategies over decades gives them a uniquely advanced, nuanced view of the market's opportunities. Also, with that, I would like to hand over now to Patrice. Again, you're welcome to take to your phones and make sure you engage as another panel discussion awaits. Thank you.
Thank you very much.
Thank you.
Firstly, thank you, Curate. Thank you, the Curate team. It is truly an honor and a privilege to be here today, and also to be in your company and among some of our peers. So, by way of background, before I get going, the company is 21 years old. There's a slide at the back. We started as hedge funds. We were maybe the third or fourth hedge fund in '98. I started the company in 2003. And it's important to state that our background was long only. I came from Liberty Asset Management in the days of Donald Gordon and Roy McAlpine, Roy Anderson. And Liberty was always known for its fundamental research, its deep knowledge of companies. And from there, we stepped into hedge funds back in the early 2000s. So Visio is 2003, is 21 years old. And there are some differentiating key points that I think I'd like to highlight and makes us potentially a little bit different to some of our peers. There's a slide over here which talks about our general engagement with companies. Now, it's not general in the sense that we go and we talk to them and have a nice conversation, but where we see value, we will engage. We will engage constructively. We will not piss off the board and the management, but we will actually look to unlock value, ensure that interests are aligned. The interests between the management, the board are representing shareholders, and to ensure that the shareholders, which are our funds, our clients, their interests are being taken care of by the board. This is a list that only goes back to 2015. Some names are missing. There are one or two that may be close to home, but essentially, we've been doing this since 2003. I was in the newspapers in 2003 when Christo Visa took out Pepco for what was then 2 billion rand. 2 billion rand translates now to about 150 billion if you add up everything that Pepco was or could have been, if not the start of. So we fought back then already for the takeout of Pepco. Pepco was then 7% of our funds back then. So where we see opportunity, we will concentrate our funds, portfolios. So this just gives you a sense of the engagement that we take. We don't make a big noise. We're not in the newspapers. We will do it constructively. We will gauge the willingness of the board and management to look to unlock value, or in some instances appoint the right directors. In other instances, remove certain directors, focus on capital allocation. It could be simple things like change the name of the company to something that makes more sense. So I'll give you an example of one called Advotech. There's three instances here, but it's actually, there's one more, a more recent one, but essentially a company we've been invested in for 20 years in the funds. This just gives you a little bit of an example. When things started going sour, early 17, 16, we started sensing that the capital allocation was remiss of certain disciplines. So we started engaging in 2018, and disclosure, etc., were some of the points. And we carried on. We've actually built a good rapport with the company over so many years. And it got to the point where in 2021, we actually brought in other shareholders, Value Capital, as activists, or kind of sat on the board and almost looked after our investment. We don't like to take board positions. We got Adam Gray to sell down. We got Coronation to sell down. We sold down. We got VCP in for 6%. And proof is in the pudding. This is what Advotech has done since 2014. If you go back further, you'll see a compounding return of 14% a year. So even in hedge funds, you can hold on to good companies for a decade or 2 decades. In this instance, relative to the all share, you can see what the company's done. Now, this discipline very much permeates across the way we manage our funds. In the Curate Balance Fund, it will once again be the same disciplines that we apply, and essentially that's how Momentum has known us to manage funds. We follow a very disciplined approach in the balance funds, which is a beautiful vehicle to have because it aggregates what we do in the long onlys, what we do in the hedge funds, what we do with our fixed income team headed by Johnny Myerson, who's a brilliant fixed income and a bit of a legend or a doyen of the industry. And thankfully, through all that, this experience, we aggregate all of that in the balance fund. Like our other peers, it's a concentrated portfolio. We have about 30 equity positions. We follow a pretty disciplined approach in the way in which we construct the portfolio. And the next slide just depicts the makeup of the portfolio currently. The nice thing with the balance fund is you can shift direction a little bit. We shifted direction a little bit before the GNU. We thought the downside was quite limited, and then we increased it post GNU. We added a bit more domestic exposure. Domestic exposure means reducing even local shares that have rand hedge characteristics and buying more property, for example. We bought a bit more banks, etc. That's the beauty of a balanced fund. We shifted the fixed income portfolio a little bit also. And again, that just talks to the flexibility we have. We're a boutique fund manager. We run about 30 billion rand. We can move quite quickly. We are not limited in terms of our ability to make decisions quickly. The next slide just gives you further ideas to the companies that we like. Many of these will be familiar to you. I think some of the interesting ones are what's in special opportunities. We actually have a letter for Johan Rupert, for Renette. We haven't sent it yet. It takes a lot of balls to send Johan a letter and to kind of question or debate with him what he's doing within Renette. Renette is a beautiful vehicle. It holds 49% of Pensions Corp in the UK that is very involved in the pensions risk transfer that is happening in the UK. We've been invested in Renette for the last 2.5 years. We very much like this theme of moving defined benefit plans off corporate balance sheets in the UK onto writers of annuities. It's happening in the US in a big way. It's happening in the UK. Renette has given us about a 35% return plus dividends in 18 months. Momentum, we like SAPI, another special opportunity with some great breakup value. So again, we are engaging with the board. We are doing it constructively. We're not wanting to upset them or in essence, it's ensuring interests are aligned. One other interesting one is Alexander Forbes, another one where we are one of the last remaining shareholders. We've been invested for about 4 or 5 years. David de Villiers has done a pretty good job there, but essentially, it's a business that is generating huge amounts of cash. It has 2 remaining shareholders, ourselves being one. It's essentially a company that at some point will delist. So these are the types of things as a hedge fund manager, you see the opportunity, you engage, you sit with a position, we're not bound by the index, and the balance fund had 8% in Alexander Forbes until we sold some to the biggest shareholder. He keeps nagging for shares. So we're in good company. From our offshore exposure perspective, we're not going to profess to be rocket scientists or to be better than anybody else because it's a pretty big market out there. But we do focus on themes. We break down our opportunity set across themes we believe are relevant for the medium to long term. The important ones, obviously, are all those that are touching the increased urbanization around the world, the emerging different forms of spending, and it's just incredible the opportunities that we can touch. I actually listened to the last week's Amazon's results this morning at gym. And it's a company we've been invested in for a number of years now in our offshore funds, in our hedge funds, in our balance, in our flexible mandates. It's just an incredible, the infrastructure they've put down that is pervasive, that will continue to grow, generating huge amounts of cash now. And similar to something like a Microsoft from a digital age and with this whole open AI, etc. But I think you must look at a Microsoft almost like a utility. A utility is something you use on a daily basis. It's kind of a necessity. I think right now Microsoft very much fits the bill of a utility. We use something of Microsoft every day. We pay a subscription every month. It's almost a hidden sunk cost, and it's goes on 2 billion people that are on the Microsoft 365 and Windows, Excel, etc. So just some examples. We don't try and reinvent the wheel. There will be some things that are interesting. We invested in GE Vernova as it got unbundled out of GE we just know the incredible demand for electricity and decarbonization and taking away coal-fired power stations towards gas and towards other forms of electricity, even nuclear. GE really fits that bill. So, and then Novo Nordisk, you would know, is around obesity. So simple themes, and this is how we populate the offshore portfolio. As I mentioned earlier, Visio is 21 years old since July this year. We have 15 investment professionals. 68% of the portfolio of the shares are held by the staff. We have 2 strategic shareholders. We have presence in London, in Tel Aviv, Sydney, Cape Town, where your fixed income team is, and Johannesburg. And we've got roughly 30 billion under management. And we enjoy what we're doing. We're very focused. We don't make a big noise. And we are very excited about the opportunity to do justice to the Curate Balance Fund. Again, thank you very much. I've been told I must put in this is some of the key members. You'll meet Jonathan. He'll come up just now. And I just need to remind you that there's a disclaimer. So we are absolved from anything that we say in case it doesn't work out. I don't know where the disclaimer's gone.
I have to point out, Patrice, you're the only presentation that didn't have a disclaimer, so our eyes on you, okay? Thank you, Patrice. Let's give him another round of applause. Well spoken, with so much reassurance, and again, the notion of people's coming up. You know what's wonderful? It is good to see that the room is still full. So thank you so much for staying and enjoying the afternoon with us. Now, next, I would like to welcome Junaid Bray from Laurium Capital. I saw him getting mic'd up earlier to join us here on stage. Junaid will be taking us through how Laurium finds the best local and international opportunities for the Curate Equity Fund. Junaid is a portfolio manager at Laurium, and he forms part of a diverse, experienced team that ensures that every investment idea is thoroughly analyzed and also tested. We can engage again with our phones, and we really hope you have a disclaimer.
Thank you. Good afternoon, everybody. I'm Junaid Bray, one of the portfolio managers of the Curate Momentum Equity Fund. So just to give a bit background about Laurium and who we are. So Laurium was really started in 2008, just before the GFC, by Murray Winkler, sitting at the back there, and Gavin Forberg, both ex-Deutsche Bank, set up initially a hedge fund with money from friends and family, and then went into the tough period of the GFC. Came out quite nicely at the other end of that, obviously having gone through a very harrowing experience. And then subsequently diversified the business, going into long-only funds, as well as African equities and global equities over time. So we've really built up the team and capabilities and experience. And one of the things we have done is that we've integrated our research process and team. So we have one team of 18 investment professionals, and we do SA equities. We've got a strong capability in Africa. We have teams on the ground meeting companies. And then also in the last couple of years, we've complemented that by building out our global capabilities. One of the other things about Laurium, we've got a small ownership by a charitable trust. Other than that, the business is 100% owned by our current staff across the board, from the founders, Murray and Gavin, all the way down to many other senior investment professionals, as well as business development and operations people. And all of that's come together. I think we've got a longer-term track record. We rank about mostly first and second quartile across our funds over the long term. If I had to summarize Laurium, and I think one thing that we try to, as we've grown, we've tried to stick to the entrepreneurial and boutique flair that made us successful at the beginning. We're cognizant about as we grow, we don't want to introduce bureaucracy into the business, and we want to continue to remain agile and nimble. And we try to keep that as part of the culture of the firm as we've grown. So just to touch on the Curate Momentum Equity Fund, I mean, we're really proud to be partnering and happy to be partnering with Curate. The fund is really mostly South African equities. About 2/3 of the fund will be South African equities, and a third will be supplemented by some of our best global ideas that we will include in the fund. And what that does is, I think, really, if you look at the South African equity market, there are certain stocks, sectors, geographies that you won't ordinarily be able to access directly in the South African equity market. So we supplement some of those best ideas, and the aim is really just to get, from a bottom-up perspective, the best ideas into this fund and generate alpha over time. And it does help to reduce the risk as well by diversifying. So if I look at our investment philosophy, really fundamental, bottom-up fundamental investors, that's valuation-based, the valuation focus. That's in our DNA, in a nutshell, what we do, and that speaks to all of our funds that we run. We implement the same investment philosophy and approach from a bottom-up selection perspective, and that's where our team and our analysts spend most of their time analyzing the bottom-up securities on that basis. At the same time, we do apply a macro overlay. We understand that companies and industries don't operate completely in a vacuum. And when we're investing, we try to get a sense of, at least a view of, what is the outlook in the short to medium term for certain indices and geographies from a macro perspective. And we apply that as an overlay, really, but really sticking to the bottom-up fundamentals. And then, given the hedge fund DNA of the firm, special opportunities where they do arise and where it is applicable to implement some of these ideas into the fund, we would take advantage of those and implement those ideas. And we've made some good alpha from some of those ideas over time. So the fund takes basically from the SA listed equity universe, that's about 65% roughly, and then about 35% of the global best ideas, and we put that together. From the portfolio managers responsible for this fund, so the four main portfolio managers on the SA equity side would be Murray Winkler, Gavin Forver, myself, and Mike Lawrenson. And then Rob Willerman, who heads up our global portfolio manager. We work closely with him to get the best global ideas, a curated range of the best global ideas into this fund. And I think there's the other thing about our team is depth of experience. I think all of the portfolio managers on this fund, lots of gray hair, in my case, no hair. Over 20 years of experience in the market, all of us on this slide, and supported by the team of analysts that we have in the background. So if I just touch on some of the ideas that we have in the fund and looking at some of the buckets and the way we think about how we dissect the market, we've got some of the non-resource ranges, the global sort of consumer names in the fund, Naspers and Prosus, Anheuser-Busch, Bidcorp, British American Tobacco. But then really, we're quite excited at the moment, given the more positive economic outlook post the GNU on the SA Inc. side, and that's really from a SA Financials perspective. We've got a significant amount of banks in the portfolio, as well as insurers. So FirstRand, ABSA, we also own Momentum. We've done well out of Momentum in this fund, continue to hold that position. And early in this year, we were adding more SA Inc. to the portfolio. We've had Foschini Group for a while. We've had Motors, so we've added a bit to that. And then early in this year, during the earlier sell-off, we added to the likes of Bidvest, Remgro, Allwoods as well. And then on the resources side, Anglo American, we really like the copper in the portfolio. We think there's a lot of value to be unlocked, and you could see with BHP split early in this year, that's an attractive portfolio and asset to own. And then from the packaging side, Mondi, and we've also had Anglo Gold for some gold exposure into the fund as a diversifier to offset. In terms of some of the global names that we've included in this fund, we've taken a more pragmatic approach to the AI theme. We think it's real. We have to be cognizant and cautious about some of the hype around it. But where we think there are real winners, we've added some of those names, the likes of Microsoft. I agree with Patrice earlier. I think Microsoft, it's one of our top ideas in the fund. I think there's a long runway in terms of monetizing the AI opportunity. And then some of the tech and the semiconductor names we've added in the likes of Broadcom. And then from a consumer name, again, beverages, soft beverages, we don't really have access to that in the SA market. So we've chosen a Mexican co-partner called Arca Continental. And then in terms of healthcare stocks, we don't have pure pharma in our market, as well as United Health. And on the industrial side, we placed our Sasol position with Shell, where we think there's it's better diversified. It trades at a significant discount to the US peers, and lots of upside on Shell with great returns in terms of returns to shareholders. And then from an electrification perspective, GE Vernova in this fund also. So just to summarize all of that, I really think, from Laurium's perspective, I think we given the hedge fund background, we cognizant about the managing downside risk. I think the team is quite, very integrated in the sense of SA, African, global, and really just to maintain that nimbleness and agility of a boutique is what drives us every day. And we eat our own cooking. All of our guys, we don't have PA trading. Our money is all invested in the same funds alongside clients, and we're all shareholders in the business, aligned with our investors. Thanks.
See a disclaimer.
The disclaimer.
Yeah. I don't know how this works, so.
Oh, just the forward button.
There's a disclaimer.
Disclaimer.
Thanks so much. Let's give Junaid a round of applause. Thank you. Ladies and gentlemen, this is going to get exciting. So, Junaid, don't go anywhere. Natalie, will you please join us back on stage to moderate our next panel? This one called A Balancing Act, Managing Risk Within Equity and Multi-Asset Funds. With Patrice, we're bringing Jennison on for the first time, who's also the head of fixed income, a portfolio manager at Visio Fund. Earlier, we heard about him. As well as Junaid that you just saw in action. Murray, if you can join us, a co-founder and portfolio manager at Laurium Capital.
Thank you, Alana. And thank you, teams who got here, Laurium and Visio. Such great privilege to be on this stage with you guys. While you manage very different, I suppose, portfolios for Curates, I think what's critical is obviously you guys manage capital growth components we're trying to deliver capital growth for our clients, whether on a more balanced approach or pure equity approach. I think what's really, whilst very different, what's common across both of you guys is your deep hedge fund heritage. It would be great if you guys can both just explain how that hedge fund experience really helps you to manage risk within your guys' equity and balanced portfolios.
We started out as a hedge fund managers, I guess, 16 years ago for the first 4 years. And the mandate is very much absolute return. So you're very cognizant of the net exposure to markets, of your gross exposures, and then drawdowns, whether it be monthly drawdowns, but more importantly, max drawdowns. So you're constantly aware of the markets and protection. Now you use quite a bit of derivatives on that, and throughout time, which sectors, how they correlate, how it works together. So risk management is very important in a hedge fund, and I guess that is sort of the DNA of the organization. When we moved into the long only space, the first fund we went into was flexible, which does enable you to do a lot more. A long-only fully invested fund, I must say, is not quite the same. So for that, we obviously have a benchmark we track, and obviously you don't want to be too far away from the benchmark, particularly on the downside. Upside's fine. But I think because of that, we monitor factors quite closely on our whole portfolio. Various factors, currency factors are very look through into earnings, currencies, different geographies, and if it's a value factor, the large cap factor. So we're very cognizant of that for a long-only fund. But I guess a balanced fund does have a lot more levers to pull, but an equity fund less. But notwithstanding, having been hedge fund managers, or we still are very much hedge fund managers, it does help you on your risk management process.
Thank you. We've summarized it. No, I'll just want to add one or two things. I think for us, from the day one, it's capital preservation. Now, it's easy to say capital preservation, and you can't just say, okay, I'm not going to lose money. But in a hedge fund, you don't want to lose money because you can only make fees or good fees if you show a positive return. The best way to show a positive return is to manage your downside and not have too many losses and big losses. And then it's about compounding. If you're compounding reasonably medium to decent returns year in, year out, because you're not having big losses and big drawdowns, that's how you get good fees, but it's good returns. And compounding with managing your downside, managing your risk is for us what has allowed us to survive and operate hedge funds. And then obviously with a balanced fund, it's the beauty of the balanced fund is we can continue to do that. A balanced fund, we're not bound by the index. We're bound by a tactical allocation, which our master here does very well. And we just have to ensure that we maneuver around that tactical allocation. And that tactical allocation allows us to, again, manage that downside and look to preserve capital on the equities positions as much as possible. And then look to compound returns within the equity, certainly the equities portion of it.
Awesome. Thank you. I suppose it links quite nicely into the next conversation because you started talking about asset allocation. So both mandates allow South African and global positioning. Obviously, by default, it's a local, global, and portfolio on the equity side. And obviously, from a balance perspective, with Reg 28 enabling you to now take up to 45% offshore exposure. What guides your asset allocation decision between the local, global for both of you guys? I suppose yours is a little bit more strategic in terms of the process. So it could be more the tactical allocation decision there. But yeah, please can you just highlight those decisions?
Sure. Oh no, I'll go first. Okay. So the framework we use for the balance fund is one of strategic asset allocation. So you've got, and you can consider that as kind of guardrails for ensuring that over time we don't kind of veer too far off our objective, which is the CPI plus 5. Patrice showed the slide earlier of like how the different asset classes make it into the fund and in what proportions. And it's basically two real important factors. One is expected return, and very important in the case of this fund, diversification and correlation, which that Murray mentioned. So, the best example is, it works well for me, is to use the bond example. Do you buy South African bonds or all global bonds? Obviously, we hold both. And from an expected return perspective, you do a valuation, you see whether South African bonds are offering you sufficient risk compensation for the risk associated with South Africa versus what is associated with the US Treasury, which is your risk-free rate, and you decided on the basis of the valuation, you want to buy South African bonds at a certain point. But the next step is to say, well, there is a correlation issue here that could consider, and that is, at times, we would actually be prepared to pay up a little bit of a premium for holding the US Treasury over South African bonds, given the diversification and the protective kind of characteristics that it has. And that is something that's, so it's a good example to in the case of fixed income, and the same framework and kind of approach we take for equities and any other, global versus local asset classes that we consider.
Right. From a equity fund perspective, it's a bit simpler because obviously there's only equities and it aims to be fully invested. So I think on a base case view, roughly about 65% will be the SA equity component and 35% will be offshore listed stocks. That being said, it's not simply a case of just taking the SA portfolio that we have and the global portfolio and putting the two together. There are other factors that you need to take into account in terms of the risk mitigation, the overlap of certain sectors. So if you're taking too much factor risk in the sense of too much Chinese exposure, too much resource exposure,
etc. So the aim is really to complement with the best ideas, but at the end of the day, what the thing at bottom up fundamental based, we look for stocks where we've got the most upside and really aim to get those ideas in the fund, but roughly on a 65-35 basis.
How much can you tax deallocate between the offshore and local? So we're seeing everyone knows.
So that could move ±5. Look, we don't try to. No, we're definitely not going to try and call the currency. So it's not the view on where we think the rand's going to go. It's really on the upside that we're seeing in SA equities versus global ideas on that basis.
Maybe to add to that a little bit as well. I mean, we talk about guardrails. So for the international component, to see us deviate from 35 to be less than 25 of that component would be highly unlikely. And obviously we can't go really above 45 because that's the limit. And the other point also to say, in managing the South African, the component, offshore is already 40% pure offshore. If you look at the Naspers, the Richmond, the BATS, ABN bets, we have offshore earnings directly is over 40%. So your portfolio on the SA side already includes a lot of international. So when you put the two together, you don't have that much that is actually pure South Africa. You're probably 25% is what you're actually looking at. So everyone gets excited about South Africa. There's only a little bucket of banks, insurers, some of the domestics, Advotech will do well. But it's quite a small component of the South African index, just as a reminder to a few.
Just for talking about some stock opportunities that you guys are looking at, Junaid. And I know a key component of your guys' process is that once a stock is added, you don't just leave it there. It's not like put it in and forget about it. It's continually reviewing, continually seeing it needs to be staying in the portfolio, whether you need to increase the holding or decrease or sell. Can you give an example of a stock that you've either recently included, upweighted, or sold outright just because of changing investment case?
Sure, it's a good question. So I think, look, to start out with investments, it's not an exact science. So we go in knowing that we're investing, we build our conviction on a set of assumptions, and there will definitely be times where we get that wrong. What we're always doing is reassessing, has the investment case changed? And that's our starting point, as the thesis changed in terms of what we originally invested in. If it's changed fundamentally, we're prepared to cut our losses and walk away. It's never a good thing. It's never an easy thing to do, but there have been times when we've done it. And unfortunately, last year we had some pick and pay in our portfolio. When the new CEO was brought in, our investment thesis had changed because he had reversed the strategy of the previous CEO, and we realized there's a lot of risk with that and balance sheet risks with that. And we decided to cut our losses and exit the position. And you could see subsequently they needed a serious rights issue as well as a sell down of the Crown Jewels, the Voxer business. So that was one where we decided to cut our losses. On the flip side, Oshini Group is a position we've had in the fund for quite some time. About a year ago, 18 months ago, when the South African market or retail environment was quite tough, and load shedding was high, retailers were discounting a lot, their earnings were under pressure. We looked at the investment case, and our thesis hadn't changed. It was just the cyclical part of the environment had been worse, and we used that as an opportunity to increase our holding during those periods, and that was like around 100 Rand and under 100 Rand. We were adding to the position. Today it's sitting at under 50. So that's one that's worked out well for us, where we've had it to the position.
Awesome, thank you. I think that goes straight inside into the process that you guys look at. It's never, as I said, add and forget. I'm going to direct the next question at you guys. I think there's a hell of a lot of balanced funds other markets, and they're very popular ones, as we well know. What has been interesting for me of engaging with you guys for a while is your positionings are often quite different to a lot of the other funds of the market. You were overweight, as an example, to property more recently, and that was a big contributor to returns. What do you think is your differentiator compared to a lot of the other balanced funds out there, and why should guys or our clients in the audience consider you guys?
So for me,
Either.
Well, I'm not quite sure what differentiates us. I can only tell you how we do things. And We are very convicted in our holdings. I mean, okay, you can't put certain of our stocks in all the funds, but we obviously look for the where it fits best. So certain shares are too small to fit in some of the bigger funds, but they fit very well in a balanced mandate where you can have more conviction and fewer holdings, and you're not bound by a benchmark, and that's important. We are not worried that we obviously consider the index, but it's not our primary focus. We very much bottom up. So as opposed to a long only where you got to be 95% and you got to hold a bit of first trend, you got to hold a bit of whatever, or you don't hold, I don't know, in a balanced fund, it's more like a flexible mandate. So is it a differentiator? For us it is, because we can express our convicted views better in a balanced mandate, in a flexible type format. And that's just where the balanced fund at least get that differentiating factor. And that's why I can say we have decent exposure to, it could be large caps. I mean, we've got, I'm going to mention Momentum because 2 years ago we bought 6% of the Momentum Group, or 3 years ago maybe now. And it was 15 Rand a share. It's still in the funds now. It was 4% or 3%. It's now 5%. It's almost doubled. So you couldn't really do that in a long only to the same extent because it was 0.5 of the index. So that perhaps is a differentiating factor. Fewer shares, more conviction. We manage a balanced fund like a flexible mandate. Almost a quasi hedge fund, but without the shorts.
Yeah. See.
Yeah.
What about future fits? Like there's potentially changing regulation down the line where you're allowed to add hedge funds into portfolios. Surely for you guys and on the balance funds perspective could be a competitive advantage, right? Because you've gotten the hedge fund experience already. Yeah. So the potential extra tool in your toolkit, you can't align.
Yeah, the beauty of that is that because I suppose both of us have a track record of our own in hedge funds, we can actually, and we did put it in our optimization model, and basically you could comfortably be up to 60% of the balance fund in a hedge fund. So, we certainly think it's got the characteristics. And while we can't do that because the regulation don't allow, the process and the way we think leans to that anyway. So I think it's extremely beneficial, particularly because a balance fund, it's a CTR plus 5. Drawdowns are very important. It's about capital preservation and a bit more, and not at any point really trying to shoot out the lights. We just need to continuously make sure that investors can put their whole pot in one spot. So I think hedge funds would be a great addition, but we can manage it given that we think that way and act as much as possible that way.
Then my last question to the Laurium team. Your differentiators, what do you think those are? You had that slide earlier about the fundamentals. You're obviously fundamental bottom-up stock because you have a bit of a macro overlay, and you've also come from investment banking, so that nimbleness, that opportunistic overlay. Can you just give a bit more detail into that and how you believe or how that drives your uniqueness?
We all like to think we're unique, but there are a lot of smart people around there and a lot of competitors that are very smart around there. So I think if we look at our team, we're able to compete with anyone on our fundamental bottom-up analysis, whether it's a business assessment, a financial assessment, and evaluation. So we've got a lot of people who've done more than half the investment team, chartered accountant, more than half of them CFAs, but still make lots of mistakes. And so I think we have the ability to compete with everyone out there. The size, I think, as Junaid put up, size-wise, we're credible, and we've a large enough team and run a decent amount of assets to be out there and to be involved in everything. The differentiating things is, yes, the one that you mentioned is investment banking backgrounds. That's we spend many years in that on sort of the research. Interesting fact. Patrice I was on the sell side analyst in the 90s, doing industrials and strategy. I used to go and present to Patrice at Liberty. Him, Roy McAlpine, Jamie Ingalls, all of them, and the Peregrine guys. We go back quite a long time. I was on the sell side there. But then we got into the investment banking side, derivatives, capital markets, investment banking, doing capital raises. So I think we have a little bit of special situation when there's a capital raise. Like this is quite a vanilla one boxer which is happening. I mean, we've had 4 or 5 of the team at meetings with management every time, looking at what we're going to do early, and we've already indicated to the CEO how much we'd go in for, and if it's the right price. Already told him that. So that when we eventually get the allocations, if it's the right price, we'll get maybe a little bit more. So how we play capital markets is a differentiated event-driven stuff. So we do focus a bit on that. It's a small part of the business, particularly in long only hedge. It's more. And then I guess the team, we do Africa. We've done Africa from day one. So if you look at the bank, Standard Bank, 50% of the earnings come from the rest of Africa. So our banks guy will probably spend in Nigeria, Kenya, at least once a year meeting with the CEOs there as well, and he does banks here. So that integration, I think, also does help quite a bit. And then I suppose the same as Visio, we owner managed. I mean, we do. Interesting. We don't allow PA. I don't think I've signed a PA trade in 3 years for anyone in our staff. The money has to go into our funds. Very different to a lot of players. So we're very much aligned. If we bugger up, we're buggering up alongside you. And I think that's very important in life.
Awesome, thanks. Well, thank you guys. I think we've run out of time. Great insights into the balanced fund and the equity space, whether you're wanting capital growth in a more balanced environment, and obviously suitable for Regulation 28 compliant portfolios. And of course, if you want to take more of the higher risk component, there's a lot of attractive valuations in the South African equity markets at the moment, as well as the opportunities in the global. We've got the equity fund available too. But thank you. I'm going to hand over to Solana. Thank you, guys. Insightful, Natalie. Thank you so much. Let's give our panel discussion a warm round of applause. Thanks so much. Well, there is no denying that risk management is so important within these growth asset classes. Ladies and gentlemen, as we almost draw the formalities to an end, I would like to bring back our amazing and beautiful poet. Let's give a warm round of applause to Emma for giving us some food for thought.
Magic mirror on the wall, come from the furthest place. I summon thee, let me see thy face. Mirror on the wall, speak. In this maze of information overload, which strategies should I seek? Who are the disruptors amongst them all? The revolution. Find me solution. Whatever you are looking for awaits you. It is not far from your reach. There are a people who are solutionist at their core, who sift through the noise and rubble with you. They are excellent custodians of your valued assets. There is an empire, the guardians of its land, meticulously hand-picked artists from all corners of the earth to dwell therein. Therein lies a diversity unmatched in insight and competency, a uniqueness akin to none. The people of this empire have far wide, local and international reaching wings, with a global eye view, a long-term lens. With a purpose so great, for the vision is beyond self, beyond the bottom line. It is no surprise that they go above and beyond to safeguard one's financial dreams, to care for coins. It has been sung across the seas that nestled within their empire is a fascination for simplicity, a deliberateness with every brand decision, its grandness felt in the air, carried by their very breath. An attention to detail Leonardo da Vinci himself would be most proud of. With the desirable end in mind, and equipped with knowing individuals' needs and wants, it has been told that these artists truly align to people's income, capital growth, and global diversification needs. Say, Your Royal Highness, what do you seek? If it be fruit, well then, the fruits of the empire are a marvel, so distinct in their composition, deliberate in their cultivation. It is also said very often, dream with your eyes open. Why not live from the dream? Gravity does not hold one back from flying up in the ideal, from one meeting their most important objectives. Whispers in the wind know that Curate is the next best investment solution, what asset management has been waiting for. Now this is the art of investing.
With that brings the day to a close. What I hope you've experienced today is everything that I mentioned and Jeanette mentioned at the beginning. We all understand that we're in the business of trust. And we also mentioned that this is about people. The people that you've seen today, be it the team, Curate team, artists, the underlying investment managers. These are people that were well vetted and we've decided to partner with because we believe that we stand for the same thing, and that is creating value for our clients. The reason why all of you are here today is because you are our partners, and we look forward to continuing this journey with you going forward. Please reach out to us, reach out to the managers that you've heard and spoken to. We're all going to be here today and further on until this evening. You've got traffic anyway, so there's nowhere to go. So you may as well stick around. But once again, from the bottom of my heart and on behalf of all of us at Curate and I suppose the underlying investment managers as well, I'd like to thank you. I'd like to thank you for spending the time with us this afternoon, and I hope you've thoroughly enjoyed yourselves. And I look forward to partnering with you going forward. Thank you.